Welcome to Acera's pre-retirement seminar. In this seminar, I'm going to tell you all the things that you might want to know in the 3 years leading up to retirement, or maybe even the 3 months or 3 weeks leading up to it, because you're going to retire soon, and you probably have some questions. Questions like, what do I need to know? What do I need to do, if anything? So I will answer those questions for you during this presentation. Now I have organized the answers to those questions and much more information into the form of this checklist. So the whole presentation will kind of go through this checklist. This is your pre-retirement checklist for the purposes of this presentation. So I will help you understand your membership with Acera. We'll talk about your contributions to Acera. We'll look at a retirement timeline, and we'll talk about your tier. I will also help you understand how to get an estimate of your retirement benefit that you can expect when you retire. We'll talk about the retirement formula, so how we calculate that retirement benefit. I'll talk very briefly about purchasing service credit. We'll talk about, at length, how vacation affects your salary, how basically selling or getting compensated for your unused vacation affects the salary component of the formula that we use to calculate your retirement. I'll show you our benefit estimate tool that we have online for you. And then, in the second half of the presentation, I'll help you verify your retirement eligibility. I'll help you choose your retirement date. We'll talk about the application process to actually retire, and we'll talk about the 5 retirement allowance options that you will choose from when you are filling out your application. I will also help you understand some other benefits that we offer, medical, dental, vision, and a few others. And then we'll talk briefly about some life events and signing up for Acera News. Okay, so we got a lot to cover, so let's jump right in. Okay, first off, let me help you understand your membership, and let me open up the Q&A here just so I can make sure to track the questions. Okay, understanding your membership. So let's start at the beginning. Who is Acera? Well, Acera is the Alameda County Employees Retirement Association. There's about 90 of us that work here. And what we do is we provide retirement, disability, and death benefits to our members. And that's all of you. So you are also part of Acera. You're part of the WHO. And you're a member of Acera because of the position that you work in. So you work or worked at some point full-time, okay? And that full-time work was in a retirement eligible position, or is in a retirement eligible position. That automatically makes you an Acera member. So you automatically become an Acera member. And the position that you work for is for one of these 6 participating employers that participate in Acera. So these are the 6 agencies in Alameda County that use Acera to provide retirement benefits to their employees. So if you work in that full-time retirement eligible position for one of these employers, that automatically makes you an Acera member. Okay, so as an Acera member, you pay into Acera's fund with every paycheck. If you look at every paycheck in the pre-tax deductions column, you'll see a line that comes out of your check and goes into Acera's fund. And your employer also makes contributions on your behalf. Now, we don't just let that money sit around and collect dust. What we want to do is we want to earn some interest on that money. So we invest it in a broad portfolio of investments all over the world. And we do earn a good amount of interest on that money. So these 3 sources of income combined give us Acera's fund. Your contributions to the fund, your employer's contributions to the fund, and the earnings that we collect when we invest the fund. So then what do we do with this big pool of money that we call Acera's fund? Well, meanwhile, you are earning credit toward retirement while you work. So you're working your job, and as you work, you're earning credit toward retirement, more and more credit as you go along. And I'll talk about what that means in just a little bit. Then, at some point in the future, you're going to retire. And then at that time, you start collecting that retirement that you've been earning throughout your entire career. You're going to get paid that retirement in the form of a monthly allowance every month for the rest of your life. You cannot outlive your retirement. It's amazing. Pensions are very special in that way, that it's a guaranteed retirement that you can count on for the rest of your life. So that is your lifetime monthly retirement allowance, also known as your retirement benefit or your pension benefit. These are all kind of synonymous terms for the same idea of you receiving a monthly payment every month for the rest of your life based on the credit that you've earned toward retirement while working. Okay, so here's the timeline I was talking about. And let me see, I have a question that just popped up. Let me address that question in a little bit. Okay, so this is the timeline that I was talking about. We have these pension milestones here on this timeline for you. So this kind of is a high-level view of some of the different markers that you'll see, the milestones time-wise in your membership with Acera. So the first milestone on this chart is your date of hire. This is your first day of work in your full-time retirement eligible position. So for many of you, this will be your first day that they told you to show up to work. For some of you, this will be the day that you got promoted from maybe like a part-time into that full-time retirement eligible position. Okay, then what happens is 2 weeks goes by, and the first day of your second pay period, that is your date of entry into Acera. So this is the day when you start earning that credit toward retirement, and this is your first day of membership with Acera. Now there's a couple of our employers, I think it's Livermore Area Recreation and Parks District and the Housing Authority, where actually your first day of membership in Acera is your date of hire, okay? But for everyone else, it's the first day of your second pay period. Okay, then what happens is 5 years goes by. And once you have earned 5 years of service credit, that means that you've worked full-time or the equivalent of full-time for 5 years, or the equivalent of 5 full-time years of work, you're considered vested in the retirement system. And vesting, maybe you've heard that term, it just means guaranteed. So the term, when you're vested in the retirement system, it means you are guaranteed the vested benefits. You're guaranteed the guaranteed benefits, basically. And I'll talk a little bit more about that in just a minute. So, okay, so that's 5 years. Then what happens is there's some date after you become vested, and it's going to be a little bit different for everyone, where you become eligible to retire. And it's based on some combination of your years of service that you've worked and your age, and I'll talk about how to become retirement eligible. Many of you probably already are if you are watching the pre-retirement seminar. So once you're eligible to retire, you can retire immediately if you want. You can retire on that day. Or you can keep working and earn more credit toward retirement, because at some point after that, there's going to be a retirement date that you choose. Now, your retirement date could be your retirement eligibility date or sometime after that, if you want to keep earning more toward retirement. So this is your first day of retirement, and this is when you start collecting on that retirement that you've been earning throughout your career. And you're going to collect that retirement that you've earned every month, like I said, until your death. And that's when your retirement payments stop. But then there's another milestone on the chart, which is that for many of the different options, there's 5 different options, like I said, that you select from at the time of retirement, 4 of them will allow you to leave a continuance to another beneficiary, and most of the time the continuance will go on to their death. And the continuance just means a continuing monthly payment. So they would get paid a monthly payment until they die. And so that's the last milestone on the chart. Okay, let me check out this question here real fast. So you're looking at your paycheck stub and you're seeing Acera EE, Acera Basic EE, Acera Cola EE, and Acera Cola XS EE. Why is it broken out? There's different calculations for the percentage of your pay that goes into Acera based on these different segments of your pay. We're collecting some for your pension, we're collecting some for your future cost of living increases, and then there's this weird part of the law where the first, it's like $151 or $160 has a different contribution rate than the rest of it. I don't know why that's written, so that's why it's broken out like that. If you want to see what your basic average contribution rate is for you as an individual, you can go to acera.org/contributions, which I think I showed that address down here, acera.org/contributions. Okay, so at this point I want to introduce you to the worksheet that I prepared for you. Let me readjust my presentation here. So that I can see all the questions. Okay, so what you're seeing right here on this slide is just one piece of this worksheet. You got a link in the email when you signed up for this seminar to go to this worksheet. If you didn't download that or access it already, what I will do is I will change my screen share and I'll show you how to get to it. So all you do, you go out to our website, acera.org, okay, and you go under news and events, and you go down to retirement planning seminars where you signed up for this seminar. And you just scroll down to pre-retirement webinar, and then there's a link for retirement planning worksheet. So this is your takeaway from, this is kind of designed as your takeaway from this webinar. There's a lot of information in the webinar, and what we found over the years is that, you know, it's because it's like 3 hours worth of info, it's kind of hard to retain. So if you have this worksheet that you can fill out with your specific numbers as you go along, whenever you come back to the webinar info to kind of figure out what you learned, you can see what your specific numbers are that you learned about yourself and your career and your membership with Acera. So you can fill this out as we go along. If you go ahead and download it by clicking the download button, you can actually fill out it has fillable fields, or you can simply print it out and do it with a pencil or pen. Okay, let me go back to the presentation. So in the My Career Timeline portion of the worksheet, if you like at this point, you could fill in your Acera entry date. If you happen to know what it is, it was a long time ago, and so you could just fill it in approximately. So for these dates, you can fill in approximate dates if that's all you know. If you do log into your account on our website, it will tell you what your exact Acera entry date is if you happen to want to fill it out. Okay, at this point also, if you want to, you can pencil in your projected retirement date if you happen to already have one in mind. Now, you may learn something in the seminar that might help you, want to adjust that projected retirement date. So that's why I said you might want to pencil it in at this point. Okay, really quickly about vesting. Like I said, it happens with 5 years of service credit. So basically you work 5 full-time years, or the equivalent of 5 full-time years. That includes reciprocal service if you have reciprocity with another public agency in California. And we'll touch on that very briefly, but it's basically you have different retirement systems in California that if you worked for another public agency in California and you've linked them together, then you get some benefits by linking the pension systems together. And one of the benefits is that the 5 years of service credit that you earn under all the systems combined gets you over that 5-year mark for vesting. If you don't have reciprocity, you just simply think of it as, I worked for 5 full-time years and I'm vested in the retirement system. And the guarantee, like I said, vesting means guaranteed. The guarantee is guaranteed by state law, the California 1937 Act, County Employees Retirement Law. Okay, and then the vested benefits are the monthly retirement benefit for the rest of your life, also known as the monthly retirement allowance or pension benefit, and then a cost of living adjustment, which is an annual percentage increase to that retirement allowance, as well as a $1,000 lump sum death benefit. And there are other death benefits that are associated with the different retirement options, the 5 different retirement options that will provide a larger death benefit than this $1,000 lump sum death benefit. Okay, so those are the guaranteed benefits. Let me see, I have a question real fast. Can you collect from Acera and Social Security? Yes, you can, because they're 2 separate systems, and in fact they don't really affect one or the other. So you could actually retire from Acera fairly early. Some people can retire as early as age 50, and I'll talk about retirement eligibility later, but then you're not eligible to collect Social Security until age 62 at the earliest. So yeah, you can collect totally separately and get your benefits from both. Okay, so now that we know what your vested date is, on your worksheet you can simply fill it in. It's 5 full-time years after your Acera entry date. And if you know you're already vested, the vesting date isn't super important, so you can just estimate if you want. Okay, let me talk about your tier. You all fall into one of these tiers. Tier 1, 2, 3, or 4, and they're separated out between general members and safety members. Okay, and the tier that you're in is based on your Acera date of entry, so that first day of Acera membership. So let me help you find which tier you're in based on these charts. Okay, first of all, you're either a safety member or a general member. Safety members are sheriff's deputies and probation officers, and there may be some other sworn officers in there. So if you're a safety member, you're going to look at this timeline down here at the bottom. Now everyone else is a general member. So you're going to look at the top timeline unless you're a general member for the Housing Authority, and then you look at the Housing Authority's timeline, or if you're a general member for the Livermore Area Recreation and Parks District, you look at the LARPD timeline. Okay, so now the way this works is, if you entered a SARA before the cutoff date for each tier that is listed out on the timeline, then that puts you in the earlier tier. So for example, if you entered a SARA before July 1st, 1983, and you're a general member, that puts you in Tier 1. If you entered a SARA July 1st, 1983, all the way up to December 31st, 2012, that puts you in Tier 2. If you entered a SARA January 1st, 2013 and beyond, that puts you in Tier 4. So that is how the tiers are determined, based on your date of entry into a SARA. You'll see the Housing Authority has different cutoff dates, a different cutoff date for Tier 2. LARPD has an entirely different tier, Tier 3, with a different cutoff date. Safety members have different cutoff dates here, and they have more tiers. So if you entered a SARA as a safety member between October 17th, 2010 and December 31st, 2012, you either went into Tier 2C or Tier 2D, and you made that selection within 45 days of establishing your safety membership. If you don't remember which one of the tiers you're in, you can simply log into your account on our website, and it will tell you exactly what tier you're in, and that actually goes for everyone. If you look in your account on our website, you can see exactly what tier you're in. Okay, so now that we know what tier you're in, you can go ahead and mark that on your worksheet, if you like. If you're a safety member, you may have done some general member work before your safety membership, and you can either mark it, 2 boxes, because you have some work, some service credit as a general member and some as a safety member, or you could do 2 different worksheets if you want. When we go to calculate your retirement, when we do the retirement formula, we'll use your service credit and age factor percentage for the general membership in one calculation, your safety service credit and age factor percentage for the safety calculation. We'll do 2 separate calculations and then combine the dollar amount and send you one check. That'll make a lot more sense when I start talking about the retirement formula right now. Okay, so next topic, estimating your retirement benefit. In order to get a good idea of how much money you are going to receive in retirement as your lifetime monthly allowance, it's really helpful if you understand how we calculate that dollar amount. And this will not only help you understand your estimated monthly allowance for the rest of your life, it will help you kind of plan out the rest of your time as an active member with the SARA. So let me explain to you how we do these calculations. And this is our pension formula. This is the formula that we use to determine your lifetime monthly retirement allowance. Okay, so here's how it works. Once you retire, we're going to do this calculation for you. Okay, and in retirement, what you will receive as your lifetime monthly retirement allowance is a percentage of your highest salary, your highest working salary, for each year of service that you've worked. Okay, now this is a sentence that kind of describes this multiplication that we're doing. Okay, you're going to get a percentage of your highest salary for each year of service that you work. Okay, so let me give you an example, and it'll help illustrate this better. Okay, let's say that the percentage of your highest salary that you're going to get for each year of service is going to be 2%. You're going to get 2% of your highest working salary for each year of service. And let's say that you work for 20 full-time years, or the equivalent of 20 full-time years. Okay, that means that you will get, as your retirement allowance, 2% of your highest salary for each one of these 20 years. 2% for each one of these 20 years means that we're going to multiply out 2% times 20, which means 40%. So your highest average monthly salary, your retirement allowance is going to be 40% of your highest average monthly salary. Now let's say that your highest average monthly salary while you're working is $5,000 per month, just to do like nice round numbers. Okay, so that means that you're going to get 40% of that working salary as your retirement allowance. So we multiply those together. That means your retirement allowance every month for the rest of your life is $2,000 per month. Okay, so it's not super complicated. Now, how do we arrive at each one of those numbers in the formula? Let me show you the formula one more time. The H factor percentage times the service credit times the highest average monthly salary. Let me tell you a few more details about how we calculate each one of these three numbers that we multiply in the formula. Okay, first I'll talk about the H factor percentage. And I do have a question up there. Let me address that question real fast. Is working part-time while on SDI, which I think is state disability insurance, affect your years of service? Let me get to that in just a minute. Okay, actually, when I talk about the years of service credit. Okay, so let me talk about the first factor in the equation first, the H factor percentage. Okay, so in the example I gave you 2%, but it's not necessarily going to be 2% for you. It's going to be some other percentage probably, and it's based on how old you are when you retire. And we use a chart to determine what the percentage is based on your age and your tier. Okay, so what I'm showing you in this slide is an example age factor percentage chart that we're going to use to determine what percentage to use in the formula for you. The way that you are going to find out which percentage that we're going to use in this chart is based on your tier and your age. So first of all, find your tier. Now, we established that you're either a general member or you're a safety member. So you find your tier number under the general heading or the safety heading, and you just look at that column. Forget about all the other numbers. We're only interested in that one column for you. Okay. Now, you're also going to look at the age column. Let's say, for example, that you're a general member, you're in tier 4, and you're going to retire at age 60. So you can probably see where this is going. We need to take a percentage out of this chart to put it in the formula. For you, we're going to go to tier 4. Under the general heading, we're going to go down to age 60, 1.80%. And that is the percentage of your highest salary that you will get for each year of service. Another way to say it is that is the age factor percentage that we will put in the retirement formula for you, multiply it by the other two factors to get your retirement allowance. Okay. Now you may notice a few things about this chart that I want to point out. One is that the percentages get larger the older you are when you retire. Okay, so another way to say it is the longer you wait to retire, the older you're going to be, the higher the age factor percentage is that you're going to receive for each of your salary for each year of service. Okay, so in that same example, if you worked another 2 years and retired as a general tier 4 member at age 62, you would get 2% of your highest salary for each year of service. If you worked another 3 years instead, if you scratched that plan and you said I'm going to retire at age 65, you would get 2.30% of your highest salary for each year of service. So it goes up and up and up until you reach the maximum age factor percentage for your tier, which is represented by the blue boxes. So you can see that for each one of the tiers has a maximum age factor percentage. And if you retire older than that maximum percentage, you're going to receive whatever the maximum percentage is for your tier. So, for example, General Tier 2, 2.43% at age 65 is the highest age factor percentage you can get as a general member in Tier 2. If you retire at 65 or 66 or 67, you're still going to get that 2.43%. The age factors stop increasing at that maximum age factor percentage. Okay, another thing that you'll probably notice about this chart is there's a bunch of gaps in the ages that I skipped. Okay, so the reason for that is because there are so many incremental increases that they don't all fit on the slide, because they actually increase with every quarter year that you age. And don't retire, you get a slightly higher incremental increase of age factor percentage in this chart. And it's based on your birthday. So if your birthday is January 15th, 3 months after your birthday is April 15th, so you go up 1 notch in the chart, and there's a slightly higher age factor percentage. July 15th comes around, that's 2 quarters after your birthday. You go up another notch in the chart and get a slightly higher age factor percentage. October 15th, you go up another notch. Back to January 15th, your birthday, you go up another notch. So every time you pass one of those dates, there's an incremental increase in the age factor percentage. If you want to see what they all are, you can find them on our website. If you go to acera.org/age, or if you simply search for age factor percentage in the search field in our website. Okay, so that's how the age factor percentages work. Now let me see, I have a question here. Why is Tier 2 so much lower than the others maxed out? Well, the reason for that is that back when the pension started, everyone was in Tier 1, and I think based on the amount that was being paid out versus how much needed to come in, the employers needed to readjust what the tier was. They needed to make the percentages a little bit lower, so that's why they created Tier 2. Now, for Tier 4, if you go straight across, you'll actually notice that the Tier 4 percentages are lower than the Tier 2 percentages. Okay, but to kind of make up for that, and Tier 4 was created by the state in 2012 when they did the Pension Reform Act, and they created Tier 4 statewide. So that's why everyone who entered Acera on January 1st, 2013 and beyond is in Tier 4. Now, I guess maybe to make up for the fact that the percentages are a little bit lower, they did provide an increased maximum percentage, so it's kind of a trade-off. So it all depends whether one is better than the other, situationally. Okay, so I think that's all I have to say about the age factor percentages. Let's move on to years of service credit in the retirement formula. So we'll talk about the second factor in this retirement formula. Okay, you start earning service credit when you enter Acera, and that is on your date of entry into Acera. Now you earn service credit while you work. You're gonna earn service credit all the way up until your retirement date. Really, it's going to be the day before your retirement date. If you're going straight into retirement, it'll be the day before that, which is your termination date. That's your last day of work, and that's the last day that you're in service credit toward retirement. Now, some of you may stop working early before you retire, and then you would actually have an extra milestone here. And I should make a new slide that has that situation on that, because some people do that, where you have a termination date and then you defer your retirement to a later date, so there's a gap between the two. You actually stop earning service credit when you stop working. So basically you earn service credit while you work. Okay, so you earn service credit during your regular work hours. You also earn service credit during your earned leave, like earned vacation leave, sick leave, management leave, comp time, holidays, floating holidays. Those do not count against you for the purposes of earning service credit. You're already earning service credit while you're out on those leave times. Now, you do not earn service credit when you're on leave without pay. You also do not earn service credit when you are out on a purchased vacation. So a purchased vacation is you purchase extra vacation which is more than your earned vacation. You purchase that from your employer. Whenever you mark purchased vacation on your timesheet, during that time you're not earning service credit. Okay, you also do not earn service credit if you sell your earned vacation. So if you take your earned vacation, you do earn service credit while you're out on the earned vacation. Now, some of our employers will let you sell your earned vacation back to them, and you don't earn service credit for that sold vacation. But if you sell the vacation during the period we use to determine your salary for the retirement formula, you could get salary credit for it, which I will go into in depth in just a few minutes. You also don't earn service credit for overtime, on-call time, or standby time. Okay. Now there are some types of time, and I'm not going to do a deep dive into this topic. We do a deep dive into this in our mid-career seminar. So if you want to get more information about that, you can watch our mid-career seminar. It's a new employee / mid-career seminar. Or you can look at our purchase page. But just to give you the concept here, there are some types of time that are eligible for you to purchase service credit. And some examples of those are part-time work that you did before you got your full-time retirement eligible position. And I'm not talking about contract work or temporary agency work. It's just plain old part-time work. That's purchasable. Also, temporary assignment pool time from the county. That's kind of the county's internal temp agency. That actually is purchasable, and that's abbreviated as TAP, temporary assignment pool. Also, if there's other types of time that you may have worked, like project work before your full-time retirement eligible position, that's purchasable. And there's a full list if you go to acera.org/purchase. That 2 weeks between your date of entry, your date of hire and your date of entry is purchasable. Unpaid leave, that is in the categories of unpaid medical leave, disability insurance leave, and military leave. That's purchasable when you return from that leave. And let me address the question that's up on the board in just 1 second regarding that. Also, redeposits of prior memberships, which is you used to be an acera member in the past, and when you left your job, you took a refund of your contribution account, and then you come back and you want to get your service credit back from your original membership, you can put that money, redeposit that money, and get your service credit back. There's also another redeposit that's not listed here, which is you got divorced or you dissolved your domestic, state registered domestic partnership, and when that happened, part of your account went over to your ex-spouse, which would mean some of your service credit and your contributions got divided off for your ex-spouse as part of the settlement. If they take a refund of their account, then you can actually redeposit that equivalent amount of money to get your service credit back, and that is called a redeposit of like a community property. And then other California public agency work. So if you used to work at another public agency in California and you're not eligible for their pension because you refunded your account from their pension, you can buy that time as a acera service credit, but it's kind of pricey. So like I said, there's a full article at acera.org/purchase that goes into detail about this. Or if you want more information, a full explanation, go ahead and watch our new employee/mid-career seminar. And regarding the question up on the board, does working part-time while on SDI affect your years of service? So any time that you work part-time, you're earning less service credit. You're earning service credit at a slower pace. So let's say that you are working full-time and then you go down to half-time. Let's say you work full-time for a year, then you go to half-time for a year. Well, during that half-time work for a year, you're really only earning the equivalent of 6 months worth of full-time service credit. So when we're calculating your service credit in the formula, we're looking at kind of the full-time equivalent. So you would get like half a year for that that year of half-time work. So that's kind of how that works. Now, if you're on state disability insurance leave, I think the way it's been explained to me is that you will get you'll get a check from your employer, and then you'll also get a check from the state disability insurance system. The part of that disability time where you're getting the check from your employer, you are already earning service credit for that time. The part where you're getting a check from the state disability insurance system, you're not earning service credit for that time, but that is purchasable time when you finish with that state disability insurance leave time. So then that becomes purchasable. So there's a question, how can you apply for TAP, the county's temporary assignment pool? I'm not sure. You would want to check with Alameda County. If you're already a member of acera, you're probably not eligible for the county's temporary assignment pool because you're already a full, a retirement earning member of acera. And so if you're looking for a different work situation, you would probably just want to check with your employer. Okay. The one more thing that I will say about service credit is what happens to your unused sick leave, because this could affect your service credit. This could increase your service credit. Okay, so the way this works is if you go straight into retirement, which means that your last day of work, also known as your last day on payroll, or your last paid day, or your last day of active employment, if that day is the day before your retirement date, then that means you're going straight into retirement, and I'll say more about that later. If that happens, if you line it up that way, which is very easy to do, and most people do that, we will convert your sick leave to a service credit. You'll get basically half of your sick leave up to a cap as service credit. So we'll take your unused sick leave that you have on the books, divide it by 2, and add that to your amount of service credit that we use in the formula for you. Now people ask, does this push out my retirement date? It does not. The only thing that this changes is the amount of service credit that we're calculating in that retirement formula for you. Your retirement date is still going to be your same retirement date. Okay, now I mentioned there's a cap on this. It's in your Memorandum of Understanding, which is also known as your MOU. And so you have to look in your MOU to see what the cap is for how much sick leave is convertible to service credit when you retire. For many of the MOUs, the cap is 125 days of sick leave that is convertible to service credit. So for example, if you were in that situation and you had more than 125 days of sick leave, let's say that you had 130 days of sick leave on the books and you retire, well, you would lose that 5 days of sick leave, that would disappear. But then the 125 days of sick leave up to your cap is convertible, and so we would divide it by 2. That would give us 62.5 days of service credit to add to your service credit number. Now it's work days, not calendar days. So let's say that you work 5 days a week. Well, that converts out to about 12 work weeks, a little over 12 work weeks. So you would get about another quarter year of service credit just for your sick leave. So that's pretty good. The one MOU that I do know that does not have a cap is ACMEA. There's no cap on it, but I don't know the caps for the rest of the MOUs. So that's how the sick leave conversion works. Okay, so that's service credit. Let's move on to, let me make one adjustment here. Let's move on to the third factor in the retirement formula, the highest average monthly salary. So we talked about the age factor percentage, we talked about the years of service credit. Let's talk about the highest average monthly salary. Okay. How do we calculate the highest average monthly salary? Well, what we're going to do when you go to retire is we're going to open up our pension software, and it's going to find your period of highest pay during your career, highest consecutive pay, which is known as your final compensation period. That is your period of highest pay from any point in your career. So your final compensation period for tiers 1 and 3 is your highest consecutive 26 biweekly or 12 monthly pay periods, depending on how you're paid. For tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. Essentially, for tiers 1 and 3, it's your highest year of pay, and for tiers 2 and 4, it's your highest 3 years of pay. So our goal with this calculation is to find your highest average monthly salary. So what our software is going to do is it's going to look, it has all your payroll records in the database so that we can do this calculation. It's going to find your highest year of pay or your highest 3 years of pay. And because it's looking for your highest average monthly salary over that period, it's going to simply divide the total pay during that period by the number of months in that period. So we take your pay for your highest year of pay and divide by 12 months for tiers 1 and 3, and that gives us your highest average monthly salary. For tiers 2 and 4, we take your total pay for that 3 years and divide it by 36 months, and that gives us your highest average monthly salary. That is the number that we put in the retirement formula for you. Now, what types of pay are going to be included in this calculation? And for all of these types, we're talking about gross pay before any deductions are taken out. Okay, so what types of pay are included here? So your base pay, of course, is going to be included, which is the main component of your salary. Now, there may be some other pay types in there. Other pay codes that you may have, sometimes they're called footnotes. There are other types of pay based on skills and education. They may count or they may not. I can't tell you off the top of my head whether they will count because there's 1,000 different pay codes. You can search for your specific pay codes on our website, acera.org/paycodes. There's a list for each one of our employers, and so you can open that PDF and do a search for your pay codes by number or by name, and it will tell you yes or no whether it's in or out of this highest average salary calculation. If you need help finding those pay codes, ask your payroll manager for help with that, because they can identify those. The one pay code that I do know that never counts is overtime. Overtime pay never counts for the salary, highest average salary. Okay, so these are the main 2 types of pay that go into your salary. Now, there are two other types of pay that could be included, and those are types of pay where you get paid for your earned vacation that you're not going to take by selling your vacation while you're still employed or cashing out your vacation that you have left over on the books when you stop working. Okay, it's known as vacation sales or vacation cash out. These could be included. Tier 4, you'll see that it says not for Tier 4. So Tier 4 members, this was disallowed by that Pension Reform Act in 2012. So you will not ever have vacation pay included, the vacation compensation for you getting paid for your unused vacation. You will never have that included as in your highest average salary calculation. Also, for those Livermore Area Recreation and Parks District Tier 3 members, you also are not included here because you're not allowed to sell vacation, and that actually disqualifies you from being able to have any of this pay included. So really, we're just talking to Tier 1 and Tier 2 members. So those Tier 4 members and Tier 3 members can take a snooze. And we're going to talk about this for like 15 minutes probably. Okay, so sorry about that. Okay, so let's dive into this topic here because people are very interested in this. It can be slightly complex if you don't get a good explanation of it. It can seem complex, but it's actually not that complicated. So let me break this down for you. Okay, so here's how this works. You have your earned vacation, right? This is one of your benefits, that you earn vacation as you work. Now, sometimes you don't take your earned vacation, and instead you are compensated for it by your employer. Now, there's two ways to get compensated for your earned vacation that you're not going to use. That is by selling it back to your employer while you're still employed. So that is you, I'm not exactly sure what the process is, but I think you contact your payroll department and say, I want to sell some vacation, and then they let you sell it, and you see your total vacation go down, and you see more money in your check. Not selling vacation while you're still employed. Okay, the second way to get compensated for your earned vacation that you're not going to use is simply that you have it left over on the books when you stop working and or retire. And they will cash you out for it at that time. And that is called vacation cash out, sometimes known as vacation payoff. So in this topic, in this concept, what we are talking about is the total vacation compensation that you are receiving for you selling vacation and cashing out vacation, if you're doing both or one or the other, depending on how you do it. We're looking at the total. This is your total vacation compensation during your final compensation period. So we're only interested in the vacation that you sell and cash out during your final compensation period. Okay. Now, for those people whose final compensation period is not at the end of their career, because their period of highest pay was sometime earlier in their career, the vacation cash out won't count. It'll just be vacation sold during the final compensation period. One more thing I'll say about that is the act of being paid for vacation, if it's close, if your salary is close between two different periods, getting paid for vacation could shift what your final compensation period is to another time. So if you cash out a whole bunch of vacation, that could make your final compensation period be at the end of your career. For the vast majority of people, your final compensation period is at the end of your career because you're getting more and more raises. But it's not for everyone. Sometimes you go down to another lower paying position at the end of your career to kind of ease your way into retirement, and that's totally fine. Your final compensation period is going to be based on some earlier period of your highest pay. But for the purposes of what this discussion that we're talking about, where we're talking about how vacation compensation affects your salary calculation, we're talking about the vacation compensation that you receive during your final compensation period. Okay, so the idea here is that if you are paid, if you're compensated for your unused vacation during your final compensation period, that means that you made more money during your final compensation period. That means your total salary during that final compensation period is a little bit higher. Because you made more total money during that period of highest pay, that also means your average salary over that period is a little bit higher. Because your average salary is one of the multipliers in the retirement formula, that means your retirement allowance that comes out of that retirement formula is a little bit higher. So the bottom line here is that getting compensated for your unused vacation will increase your retirement allowance a little bit. Okay, how much will it increase your retirement allowance? Well, here are some approximate numbers. This is a rough estimate. These are very approximate. But to give you an example, let's say that you are able to be compensated during your final compensation period through a combination of vacation sales and vacation cash out for 8 weeks worth of vacation. 8 weeks worth of your earned vacation that you're not going to use. Your employer pays you for it during that final compensation period. And let's say you're in Tier 2. That will increase your retirement allowance by 5%. At the time of retirement, so like immediately upon retirement and for the rest of your life, your retirement allowance is 5% higher. So you can see why people are interested in this topic. It can be a significant increase to your retirement allowance. So you can see what the other numbers here for you based on the different amounts of vacation compensation. For Tier 1, the effect on your salary is accelerated because we're only talking about 1 year's worth of final compensation period versus the Tier 2, 3 years final compensation period. Okay, so these are all approximate, like I said. Okay, now there's a cap on how much vacation compensation we are allowed to include in the salary calculation for you. And you'll notice the word must here, how much compensation a salary must include. So the reason that I'm explaining this to you, okay, now it may be like, from some people's point of view, it may be like, okay, well, you're showing people how to get a little boost on their retirement. The reason I'm showing this to you is because we have to, like, if you get paid for this vacation during the final compensation period and it's under the cap, we have to include it as salary by state law. And so if we are including it, we might as well explain to you how it works and how much we can include and how we include it and how it affects your pension. So this is just, this is just to make it easier for you, because this is how the pension system works. This is how we have to calculate it. So, I might as well explain it to you. So there's a cap. The state law tells us that there's a cap on how much of this compensation for unused vacation is that we are allowed to include for you. The cap is going to be different for everyone. It's based on your specific situation. Okay, I'm going to show you how to figure out what the cap is for you. First, I'm going to address Alameda Health System employees, because the way that the cap is determined for you is a little bit different from the way it's determined from everyone else, because you earn PTO. You earn hours of paid time off versus everyone else who earns sick leave and vacation in 2 different buckets. You kind of earn all of that in one bucket called PTO. So for Alameda Health System employees, and this, by the way, is a section of your retirement worksheet, that the retirement planning worksheet that I showed you earlier. Okay, so you can, when you figure out these numbers for you, you can write it in the worksheet so that when you come back later, it will make sense for you. Okay, what you need to know is one number. You need to know how many hours of paid time off you earn per pay period. You can probably look at I think you can look at your pay stub and it will tell you how many hours of paid time off you earn per pay period. So you put that in the box here. I'm going to give you an example of 6.7692 hours of PTO that you earn per pay period. Then you simply do a very simple arithmetic calculation. If you're in Tier 1, you multiply that number by 13. In this example, it will give you 88 hours. If you're in Tier 2, you multiply that number by 39, and that will give you, in this example, 264 hours. So if you're in Tier 1, in this example, 88 hours is the maximum amount of PTO we are allowed to include if you have 88 hours of PTO that you sell or are paid off for, that is the maximum amount that we're allowed to include in the salary calculation for you as a Tier 1 member. And for Tier 2, in this same example, it's 264 hours is the cap. Okay, there's one exception. For AHS employees in the UAPD union, you don't even have to do the calculation. There's just a flat number for you. If you're in Tier 1, the flat limit is 120 hours of PTO. If you're in Tier 2, the flat number is 360 hours of PTO. Okay, so that is how you determine as an Alameda Health System employee, your limit of vacation compensation includable as salary for this salary calculation. Now let me address everyone else, the Alameda County employees and employees of all of our other employers, participating employers. You're going to look at this other section of the worksheet for county and other employees, and you're going to see a grid here. Now what you need to know is two numbers. You need to know how much vacation you earn per year in weeks. So it's the amount of vacation you earn is based on seniority. So I think if you've only been around for less than 5 years, you're earning 2 weeks per year. It's like between 5 years and 15 years maybe, you're earning 4 weeks per year. 15 to 21 years is 5 weeks per year, I think. You can't hold me to that. It's something like that. But you're earning a certain number of weeks per year. And so you need to know what that number is, and you put it in the box up here. You also need to know a second number, which is how many weeks of vacation you're allowed to sell per year. Somewhere in your employer's rule book, they have a number of weeks of vacation that they will allow you to sell per year. Maybe 1, maybe 2 weeks, maybe 3 weeks. You need to know that number. So you're going to take both of those numbers and you're going to put them in the grid here. So for example, if you earn 5 weeks of vacation per year, you put it in the grid here. If you know that your employer allows you to sell 2 weeks of that 5 weeks that you earn per year, you put it in the grid here. Now for Tier 1 members, you can stop there. You only need to fill out those 2 boxes. For Tier 2 members, since you have a 3-year final compensation period, we need to know those 2 numbers for each year period within that 3 years. Okay, so for many of you, all the numbers are going to be the same. You're earning the same rate of vacation for each one of those periods, and you're allowed to sell the same amount of vacation for each one of those periods. But should those numbers change, you could fill in different numbers here in the grid. Okay, so now we have what the numbers are for the grid. Now here is where we figure out what your limit is based on these numbers, and we're going to do a calculator out on our website. So if you go to acera.org/vacation, you're going to see these calculators. I'm actually going to switch over to, I'm going to change the screen share. To show you our website to actually show you the calculators. Okay, so I'm going to go to acera.org/vacation. And then you'll see that we are at a section called Understanding How Your Unused Vacation Leave Affects Your Retirement Allowance. You're going to open this accordion for Alameda County, Courts, and Housing Authority employees. You're going to see 2 calculators in here, one for Tier 1 and one for Tier 2. All you need to do is take those numbers that you put in the chart and you put them in the calculator. So in that example, you were earning 5 weeks of vacation per year, so I'm going to delete the zeros in there, put in 5, and then I'm going to put in, select from the drop down that I'm allowed to sell 2 weeks of vacation. And then it tells me what my limit is for Tier 1, 2 weeks. Okay. For Tier 2, I'm going to do that same thing. If I'm in Tier 2, I'm going to put in 5 weeks, select 2 from the drop down, and you'll see it'll give me a running total as I put new numbers in. So I'm going to do that for each one. 6 weeks is my limit. Now to just give you an example, it's a very basic calculator. All it's doing is it's taking the lesser number from each one of these years and adding it together. So the lesser between 5 and 2 is 2 in every case, so 2 plus 2 plus 2 is 6. That's how the Tier 1 calculator works as well. You can see if I select 3, it goes up to 3. Or if I would take this down to 2, it's selecting the lesser number. Okay. So anyway, we know that in that example that I was giving you, let's stick with the Tier 2 example. The limit is 6 weeks. So let's go back to the worksheet and I'll show you where to put that in. You're going to put the limit in this box right here. That is your limit now for how much vacation compensation Acera is allowed to include as salary for the purposes of calculating your salary, for the purposes of calculating your retirement allowance. This is your limit. Okay, now There's a couple of other fields here, vacation sell and vacation cash out, because what I want to do is help you kind of plan, if you want to, if you're interested in maximizing this number. I want to kind of help you plan out how to get compensated for that vacation in order to maximize that number. So this is, again, this is how Sarah has to calculate it, so I might as well explain it to you how it works. One way to achieve this number, get up to being compensated for this amount of vacation, earned vacation, is simply by cashing out that amount. So you simply have, in this example, your limit is 6 weeks of vacation compensation. That is includable. So you simply have 6 weeks of vacation on the books when you retire or you quit working. And you don't have to sell any. That's by far the easiest way to do it, and that is going to work in the vast majority of scenarios. You just simply have that amount on the books. Super easy. Don't even worry about selling vacation. Let me give you a different example where you might want to think about selling vacation. Okay, so in this scenario, this is a tier 2 scenario. This person earns 4 weeks of vacation per year, and they did that for each one of the 3 years of their final compensation period. And they're allowed to sell 3 weeks. And just as an aside, people will ask, is my final compensation period based on the calendar year or is it based on the fiscal year? It's based on neither. It's based on, if you recall, your highest consecutive pay periods. And so let's say that your highest pay is at the end of your career, and you retire, let's say you retire on April 1st, and you're in tier 2, it's going to be the 3 years preceding April 1st. So you would go to April 1st and the year before that, back to April 2nd, the year before that, and the year before that. And that would be your final compensation period. Okay, so it's going to be different for everyone. Okay, so back to this topic. Let's say that in this tier 2 example, this person earns 4 weeks of vacation per year and they're allowed to sell 3, and it's the same for all 3 years in that final compensation period. Now if we do the calculator, we will find that it's going to take the lesser of each of these 3, so it's going to be 3 plus 3 plus 3 is 9. Okay, so that is the limit from the calculator. That is the maximum amount of vacation compensation we're allowed to include for this person as salary. Okay, now the reason I'm giving you this example is because your employer has an additional caveat for you, an additional limitation. They will not cash you out for more than 2 times your accrual rate of vacation. So in this person's example, 2 times their accrual rate is 8 weeks. They accrue 4 weeks of vacation per year. 4 times 2 is 8. If they have more than 8 weeks worth of vacation on the books when they stop working and or retire, they will lose anything above 8 weeks. Okay, but their limit is 9. So they can't just get up to the 9 by simply having 9 weeks on the books, because they won't get cashed out for 9 weeks. They'll only get cashed out for 8 weeks. So this person, if they want to get up to this limit, they actually may need to sell some vacation while they're still employed. So in this scenario, they're selling 1 week of vacation while they're still employed, and they have 8 weeks of vacation on the books when they retire, and that gets them up to the 9 weeks. Okay, so that's how you would do that. Now, if you're not in that scenario, if you're back in this scenario, 5 times 2 is 10. Okay, so you can, if you earn 5 weeks of vacation per year, your employer will cash you out for up to 10 weeks of vacation that you have left over on the books. Now, in this scenario, your limit is 6, so you can easily get up to the 6 simply by having 6 weeks of vacation on the books, because 10 is bigger than 6. It's when you can't get up to the limit because this 2 times your accrual rate is smaller than what your limit is. That's when you need to think about selling. Okay, so there's another scenario that people ask about, because sometimes people just sell vacation. And what if I already sold a bunch of vacation? What do I do? Like, how do I figure this? Well, if you already sold a bunch of vacation during that final compensation period, and you know what happened during that final compensation period, you have 2 options. Option number 1 is you can simply cash out the difference. So if you know your limit is 9 in this example, and you've already sold 5 weeks of vacation during that final compensation period, you just subtract 5 from 9 to get 4. You just cash out the difference. 5 plus 4 gets you up to the 9. So you just have 4 weeks of vacation left over on the books when you retire. Okay, option number 2 is you could cash out more than the 4. More than the difference. It's okay. Don't worry about it. You can do it if you have that much vacation on the books. All you want to simply do is not have more than 2 times your accrual rate on the books when you stop working. So in this case, in this example, this person has exactly 2 times their accrual rate of 4 on the books when they stop working, and they also sold 5. Okay, now 5 plus 8 is 13. Their limit is 9. So we cannot include 13 weeks worth of vacation compensation in the formula for you. The state law does not allow it. We can include up to 9. So we will include 9 weeks worth of that 13 as vacation compensation in the salary calculation for you. Plus, there's 4 extra that they got paid for. Now, I want to emphasize this. You still get all of the money from selling the 5 weeks of vacation and cashing out the 8 weeks of vacation. You get 13 weeks worth of vacation pay in your bank account. And that is true in all scenarios. If you sell vacation, you get extra money in your bank account. If you cash out vacation, you get all the money in your bank account. So Sarah, using that vacation for the purposes of calculating your salary doesn't mean that you don't get the money. You get the money. The fact that you get the money is what allows us to do the calculation. Okay, so in this example, this person gets a total of 13 weeks worth of vacation pay in their bank account between the 5 that they sold and the 8 that they cashed out. Okay. Before I welcome back the Tier 4 members, what other questions can I answer on this topic, if you all have any? No questions so far. Okay, well, I must have explained it really well, I guess. Oh, here we go. Okay, somebody says, thanks for the explanation, I have to think it over. Like I said, we're going to post the video on the website, so you can review it again. Also, I've explained this many times in previous pre-retirement webinar videos. So if today you want to go back and look at that same explanation again from a previous video, feel free to do that as well. Okay, welcome back, Tier 4 members. Okay, wait, there is one question. So in that example, 9 weeks is included in the final calculation. Yes. So for this person, in this example, their base pay is going to be included as salary. Any footnotes they have that we're allowed to include is going to be included as salary. Plus, 9 weeks worth of vacation pay is going to be included as salary for the purposes of calculating their retirement. So yes. Then there's an extra 4 weeks that they also got paid that will not be included as salary for the purposes of calculating their retirement. But, like I said, they still got all the cash in their bank account for the 9 weeks plus the 4 weeks. Okay, so let me go to the next topic. Welcome back, Tier 4 members and Tier 3 members. There are some limitations on your retirement allowance that it's good for me to let you know about. The limitations don't apply to the vast majority of people, but it's good for me to talk about these. So limit number 1 is that your retirement allowance cannot be more than whatever your highest average monthly salary was in the calculation. Another way to think about it is that this limitation, and it's written into the state law, is trying to prevent you from earning more in retirement than you were earning while you were working. So whatever we calculate your highest average monthly salary to be, that is the maximum your retirement allowance can be. But that limitation, it mostly holds up, except for, like I was just telling you, your highest average monthly salary can be a slight bit higher based on the vacation compensation. But that mostly holds up. Almost nobody hits this cap. almost everyone retires with less than 100% of their highest average monthly salary. To hit this limitation, you have to have worked in tier 1 for like maybe 35 years and be a certain age, and for tier 2 is like 45 years of service credit and be over a certain age. But you can achieve 100% of your working salary, and that is awesome if you're able to do it. But our average person, retiree, retires with 20 years of service credit, so not really anywhere near 100% of their highest average monthly salary. Okay, the next two limits for B and C are for people who have really high salaries, so I'm not going to spend much time on that. If you want more information about that, go to our page, acera.org/limits, and check out the information on that. Now, the last limitation I'm going to talk about is for Tier 4 members. It's a highest average monthly salary limit, which means that your annual salary is capped based on this number from the federal government called the Social Security Wage Index limit. If you make more annual salary in a year than this number, all the salary that you make above that number is not, we won't be able to consider that salary for the purposes of calculating your pension. We can only consider the amount of salary that you earn up to the cap. So that's the bad news. The good news is that when you hit the cap, we don't take contributions out of your check for any salary that you earn over the cap, and that actually gives you more money to save in other investments, including your 457B account. So there is, that is kind of the way to make up for that. But these caps go up every year, so if you're not going to retire this year, the caps will be higher next year and the year after that, so they do increase every year. The cap currently is $134,974 for general members and $161,969 for safety members. Okay, now I'm going to help you estimate your specific retirement. Because we've been talking kind of in general about how ACERA calculates people's retirement allowances, let's talk about how you get a specific estimate of your specific retirement. I'm going to show you two ways. The first way is kind of a quick ballpark estimate, and really what it does is it just shows you a percentage of your salary that you're going to get in retirement. So you just kind of think about your salary and you kind of think about what percentage you're going to get in retirement. This concept is also known as the income replacement percentage. So let's say that you learn that your retirement allowance is going to be like 40% of your working salary. That means you're achieving 40% income replacement from your pension alone. But then, hopefully there's other things that are in there, like Social Security will help you with more income replacement and any personal investments and savings. So let me show you the first way, and then I'll show you how to do the precision way to get an estimate. First way to get a ballpark estimate, and this is again a section of your retirement planning worksheet that goes along with this seminar. What you do is you think about your retirement scenario. How old am I going to be when I retire? And you put that in the worksheet. You're also going to think about, in that same situation, in the same scenario, how many years of service credit will I have earned at retirement in whole years? Okay, you put that in the worksheet. Now we're going to go out to a chart that we've prepared for you that will show you where those two numbers intersect. I'm going to go out and show you exactly to our website and show you exactly where to find that. Okay, so here's our website, here's our homepage. You're going to go under Members, Planning Your Future Retirement Income, which is the third thing down in the menu. And you'll see that step 1 is getting an ACERA estimate, and it gives you 4 different ways to get an ACERA estimate. What I'm showing you is option number 1, and it kind of explains to you exactly what I'm telling you. You're just going to click on one of these buttons, the button for your tier. So let's say you are a general tier 2 member. Let me see in my example, D29. Let me see if this is a tier 2 example. In my example, you were retiring with 29 years of service at age 58. Okay, so I'm going to find where those two intersect. Across the top axis is your age at retirement, and the left axis is your years of service credit. So I'm going to go across 29 years of service credit at age 58, and I find that gives me 50.03% where they intersect. That 50% means that I'm going to get 50% of my working salary as my retirement allowance. So that's just a quick ballpark way to show you how much you're going to get in retirement. So you're achieving 50% income replacement. Another neat feature of these charts is if you want to see what the effect of working an additional year is, all you do is proceed diagonally. Once you find the intersection of your retirement situation, you proceed diagonally down the chart. So in another year, in this example, I would be 59, and I would have 30 years of service credit, so that would give me 54.5% income replacement from my pension alone. If I work for another year, that would give me 59.42%, almost 60% income replacement. So just by working another 2 years in this scenario, I would go from 50% income replacement to 60% income replacement, and so on and so forth, and you can keep going diagonally down. So that's how that works. If you want to continue with that concept on the worksheet, you could put in the percentage that you find, and then you can kind of multiply it by what you imagine your monthly salary currently is, and it just kind of gives you a quick estimate of what your retirement allowance might be, just for the purposes of kind of doing it in your mind. So in this example, this person is getting 50% of their salary, which is $6,000, so they're getting about $3,000 as their retirement allowance. Okay, let me show you the second way, and this is the precision way to get a online benefit estimate, to get a precision estimate. So we're looking at this section of the worksheet here. What you're gonna think of right now is, in your specific retirement scenario, get a little more specific and think of a date, like a projected retirement date and a projected separation date. Your separation date is your last day on payroll. Your projected retirement date is your first day of retirement. If you're going straight into retirement, these would just be 2 consecutive days. Okay. So if you know you're going to retire in a year, and you're going to retire, let me see, let's say that you're going to retire on April 1st next year. You just pick April 1st, and your separation date is March 31st. Okay. Then you're going to go out to our website. You're going to click the login button. I'm just going to go through some screenshots here. Once you log in, you're going to see your account with Acera, also known as Web Member Services. This is our online portal that we provide to you. The first screen that you'll see is an account summary, and it will show you a lot of the data that we have for you in our pension database, including, like I was telling you earlier, your tier and your date of entry into Acera. And there's some other stuff in there, like how much service credit you've earned, how much you've contributed to the retirement system. You're going to click on Estimate a Benefit, and this will bring you to our benefit estimator tool, and you're going to use these two dates to put them into the benefit estimator. Okay, so let me just zoom in here. I'm going to put my separation date here. In this example, I'm using March 15th, 2030, and my projected retirement date is March 16th, 2030, and I'm going to hit Calculate. And what the calculator is going to do is, based on what it already knows about me in the pension database, it's going to project how much service credit I will have earned in this scenario if I work until these dates in 2030. It will also do a salary projection based on my current salary, okay? And any pay periods that are in the future that it needs to use to fill in my final compensation period for the future, it's going to use my most latest pay period to fill in those pay periods. I do have the opportunity to override the service credit number if I want to. I can override the salary number if I'm not going to retire for many years and I want to see the effect of raises and inflation so on my retirement allowance estimate, so I could include a higher salary. If you want a nice conservative estimate, just go ahead and leave it alone and don't put anything in the override fields. Okay. But if you did want to see like the effect of that like an extra quarter year of sick leave conversion to service credit, you could override the service credit. You just add a quarter year to this number and put the new total in this field. So if I'm getting that 12 plus weeks of service credit that I was showing you in the example from the sick leave conversion, that's about 0.25 years, quarter year. So you add 0.25 to this number and put it in the override field. Okay, that's how that works. I will show you how to add hours of cash vacation compensation and see what the effect of getting compensated for your earned vacation, like we were discussing a few moments ago, is on your retirement allowance. But let me just show you what the retirement estimate looks like without that first. You can put in beneficiary information here, and that becomes more important later in the presentation when we talk about death benefits and beneficiaries. And you hit get estimate, and what you end up with is a retirement benefit estimate PDF that it will look something like this. We are currently redesigning this, so it may look a little bit different by the time that you do the estimator, but it'll have most of the same elements in it. This is what it looks like. Okay, this is a PDF. You can run as many of these scenarios as you want, so you can save this, you can print it out, and this is your retirement estimate. Okay, let me show you how to add, if you like. This is purely optional, and like I was saying, if you want a nice conservative estimate, leave the hours of cash vacation compensation blank. But if you are curious about this topic that we were discussing, how getting compensated for your earned vacation affects your retirement allowance, how it increases it, then you can use that field to get estimates on that. Let me show you how to do it without overestimating. One of the main reasons that you might overestimate is because you've already sold vacation during the date range that the estimator is using to determine your salary for the purposes of doing these calculations. So if you sold vacation during that time, that's already included in the salary. So let me help you subtract out that vacation before you put in any numbers into that field. And there's a section of your worksheet that will help you do this calculation, so you can fill this out as we go along if you like. Okay, this is how to calculate hours of cash vacation compensation for the online benefit estimator. So step one is you run an estimate and you leave the hours of cash vacation compensation field blank. Okay, so we did that. We left it blank, and what you want to do is put in, first of all, you want to put in your limit from the calculator on the other part of our website in this field. This on the worksheet, you're simply transferring the number. Let me show you the worksheet again from one section to the other. So it's on page 2 of the worksheet, and all you're simply doing is taking the limit from the calculator and you're taking that number and putting it over here. Now for AHS employees, your limit is already in hours, and so you would take the number and you would start here and put the limit in hours here. Okay. For everyone else who's not in AHS, we need to convert your vacation limit weeks into hours. So we're going to take your vacation limit in weeks. We're going to write in how many hours you work per week. In this example, this person works 40 hours per week, and we just multiply them together. 40 times 6 is 240, and that is your limit in hours. And like I said, AHS members, we already know your limit in hours. You put that in here. Okay. So now we know what the limit is for how much total vacation hours you could put in that field in the benefit estimator. But if you know you sold vacation already during this this time, then you're going to want to subtract that out. So the way that you do that is you take that first estimate that you ran and you look at the average salary date range that it is using to give you a salary estimate, okay? And you think to yourself, during this date range, did I sell any vacation? If I sold vacation during that date range, how much did I sell? Okay. And then you're going to want to know how much you sold in hours, and so you put that in here in the field, and then you're simply going to subtract that out from your limit, okay? And this is the limit that you would put here in the calculator if you wanted to see the effect of maximizing your vacation pay for the purposes of estimating your retirement allowance. Now, going back, if you don't sell vacation, if you know you didn't sell any vacation, you simply need to take your limit in hours and you could put 240 right in here in this example. Okay, but I'm helping you not overestimate if you already sold some vacation. Okay, so now if you put in hours in here and you hit get estimate again, you'll find that your retirement allowance estimate is larger. Let me zoom in on your retirement allowance estimate just so you can see it a little bit better in the slide. This is your estimate right here. Okay, there are different retirement options. These are the 5 options that you will be choosing from at the time of retirement that I will explain in detail in just a little while. For this moment, you could just look at the unmodified option because this is the one that pays the most to you as the retiree. This is the one that the vast majority of people select because it pays the most. And so for the purposes of the seminar right now, if you want to put that estimate into the precision estimate part of the worksheet, you could put that number in right here if you want to. Okay, so we're going to hang on to that idea. This is your estimate for now, but then we will go into detail later on the different options. So that's how the precision benefit estimator works. Is you do it online, it gives you a PDF, you can save the PDF, you could print it out, and like I was telling you earlier, it's very precise. Especially the closer you are to retirement, that means that the salary it already has on file for you is more accurate, and so the estimator is very precise. Now, you do have another option if you want a retirement benefit estimate, which is you can have Sarah do it for you, and there's a form that you can fill out, our retirement estimate request form, if you go to acera.org/forms. But you will find when you submit this request that when our staff does this for you, they're using the same software and the same math as Web Member Services, the member portal, so you're going to get the same results, basically. The difference is that the estimator is way faster. You can make one of these estimates in 5 minutes or less, and you can make as many as you want. If you do fill out the form and want us to do it for you, can be a wait because we get a number of these requests. You'll go in a queue, and then maybe it'll be a couple of weeks before you get a letter in the mail from us telling you what the estimate is. So that's the main difference between those two. Okay, so let's move on to the next item on our checklist. I've helped you understand how we calculate your retirement allowance. I've helped you figure out how to get a precision estimate of your retirement allowance that you're going to get every month for the rest of your life. Let me talk about how you become eligible to retire and how you verify that you're eligible to retire. So what we're talking about is this milestone on the pension milestone chart here, your retirement eligibility and when you first achieve it. For tiers 1, 2, and 3, there are 3 different situations in which you can achieve retirement eligibility, and I'll do tier 4 in just 1 minute. Okay, option number 1 is that you are over age 50, you're at least 50 or older, you have at least 5 years of service credit, and you have at least 10 years of membership with Acera. And the 10 years of membership thing is that at least 10 years has passed since your date of entry into Acera. For people who are working straight into retirement, you may want to just think about this as you work for 10 years, you earn 10 years of service credit, and you're at age 50 or older, and then you can retire. But some people, you may work for 5+ years, 6 years, 7 years, 8 years, you're ready to be done working, but you can't retire yet, basically. So you stop working, and you have to wait an additional number of years, or however long, until at least 10 years has passed from your date of entry into Acera, and then you're eligible to retire. That's option number 1. Option number 2 is that as a general member, you can have 30 years of service credit, or as a safety member, you can have 20 years of service credit, and you can retire at any age, even if you are younger than age 50. So this option number 2 is basically how you are able to retire younger than age 50. Okay, or option number 3 is you can retire at age 70 with any amount of service credit, even if it's less than the 5 years of service credit you need under option number 1. So those are your three options for becoming eligible for retirement. For Tier 4, you have two different scenarios which give you retirement eligibility. Option number 1 is as a general member, you are at least 52 years of age. As a safety member, you're at least 50 years of age, and you have at least 5 years of service credit, and you can retire. And the 10 years of membership thing does not apply to Tier 4, so it's just 5 years of service credit. Option number 2 is that you can retire with any amount of service credit, even if it's less than 5 years, at age 70. So that's how you are eligible to retire. And then once you're eligible to retire, you can retire as of your retirement eligibility date, like I said, or you can keep working and earn more credit toward retirement. So now that you know basically what your retirement eligibility date is going to be, or what it was, most likely because you're watching the pre-retirement seminar, you can put that in here. If you just already know you're eligible to retire, you don't really have to worry about it. And you can just write in an approximate date if you like, just so that you remember that you're eligible to retire. Okay, so that topic was really easy. That was pretty simple. Now, let's talk about choosing your retirement date and what kind of factors do you think about when you are considering what your retirement date is going to be, because it's a date that you're going to choose when you're ready to retire. So we don't choose it for you. It's whenever you're ready to retire. And this is the date on the pension milestone chart that we're talking about, your retirement date. Okay, so I'm going to tell you about these 6 different things in terms of finding your best date to retire. Talk about income, age factor percentage dates, cost of living adjustment, if there's a conflict between those two, and how to really when it gets down to it, really choose what that date is when you have kind of narrowed down your time to retire. So let's go into detail about each one of these. A little bit of detail. They're quick topics. So this one, number 1, will you have enough income, is kind of a basic topic that some people will want to consider. A lot of people will want to consider this. I'm kind of talking around it because you don't necessarily have to think about this if you are not overly concerned about it. You don't have to dig into this very deeply if you don't want to. But I recommend it. It's a good thing to know, to take a little bit of a peek into the future. Look at, just kind of imagine what your retirement is going to be like and what your expenses are going to be like, and whether you will have enough money to pay for your retirement between a combination of your Astera retirement that you're going to receive and Social Security whenever you're eligible to start receiving that, and then any other additional savings that you have. So when you go to retire, that's going to be your sources of income, basically, is your pension, your Social Security, and any other savings that you have. One big place that people save is in the deferred compensation program in their 457B plan. So you're going to want to just get estimates of those things. Get a Social Security estimate, get a retirement estimate from Astera, see how much money is in your deferred comp plan. If you want to, you can even think about post-retirement expenses and add all these 3 things up and see if they will help you pay, for your expenses that you're going to expect in retirement. Financial planners will tell you that you will need 70 to 80% of your pre-retirement income in retirement to maintain your standard of living. So whatever you're making as a working person, you're going to need 70 to 80% of that in order to maintain your standard of living in retirement, because your expenses will be a little bit lower. So we do have more information about this out on our website. Let me show you where that is, because I'm just touching on this very briefly in case you're interested in it. So out on our website, if you go to the home page, we have a whole section on this, which is, if you go down here, there's some different topics under Ready to Retire, and you can just click on Prepare to Retire. And this is a section that we feel like it's good for you to go through in preparation for your retirement. Estimating your retirement income is one of the topics on here. And so you can take a little bit more time to go through this and get your pension estimate. There's a link to the Social Security estimator. There's a link to Social Security eligibility because, like I was just showing you, you could be eligible to collect your SARA pension many years before you are eligible to collect Social Security. So it's good to be cognizant of that as well. There's a link to the login to your 457B account. It helps you, do some projections, and then there's even a retirement savings calculator that we put a link to on here from AARP. And if you really want to dig into it, there's a budget worksheet for post-retirement expenses. All purely optional, like I said. Okay, so that's the first thing that we recommend considering. Okay, the second thing that you may want to think about, that you may want to be cognizant of, are the age factor percentage dates. So remember back to the first part of the presentation when I was telling you about the age factor percentage in the retirement formula and how those percentages of your salary that you're going to get for each year of service increase with every quarter year that you don't retire. Another way to say it is every quarter year that you age and you haven't retired yet, you get a slightly higher incremental age factor percentage in the formula for you. And if you recall, I gave you the example of a January 15th birthday. If that was your birthday, 1 quarter after your birthday would be April 15th. 2 quarters after your birthday would be July 15th. 3 quarters after your birthday would be October 15th. So you can see it's based on your birth date, and then you just add 3 months. And that tells you what those quarter year dates are that are the cutoff dates for the increases in the age factor percentage. This is purely if you have not yet reached the maximum age factor for your tier. If you have, you can just forget about this whole topic because you've already achieved the maximum age factor percentage. But let's say that you haven't yet achieved the maximum age for your tier. And let's say that your birthday is January 15th and you're thinking about retiring on July 14th. You could see that you probably don't want to do that, okay? Instead, you would want to wait 2 days. You work on July 15th and retire on July 16th, and you would pass that July 15th cutoff date for going up 1 incremental percentage mark in the age factor percentages chart. And that will actually increase your retirement allowance by a little over 1% just by waiting those 2 days in that scenario, okay? And the same goes with all of the other all 4 cutoff dates. Every time you pass one of these dates, you go up 1 notch in the age factor percentage chart. So what I'm trying to tell you is, if you haven't yet reached the maximum age factor percentage for your tier, and you're setting your retirement date, don't retire right before one of these dates. Be cognizant of what they are, and just like work another week or a few days or whatever you have to get past the date, and then you get a 1% plus increase in your retirement allowance just by doing that, just by being cognizant of these dates. Now, if you're going to retire like halfway between the 2 dates, because this is a 3-month period, so 6 weeks, you're going to retire like kind of the midpoint, it's not such a big deal. If that's when you want to retire, that's when you need to retire, go ahead and retire then. All I'm trying to do is help you to not miss that incremental increase if you're thinking about retiring right before one of these dates. Okay. The next thing that you're going to want to think about when choosing your retirement date, and this goes to the question that's up on the board, is the cost of living adjustment date. This is something that some people will consider when choosing their retirement date. So let me explain the cost of living adjustment to you, because I showed you earlier in the presentation that it is a vested benefit. It is a guaranteed benefit. It is an annual increase to your retirement allowance. It's a percentage increase. And the percentage is based on the Consumer Price Index increase for the San Francisco Bay Area, which is a measure of inflation that is calculated by the federal government. So we're looking at the CPI for the Bay Area and how much it increases December to December, and that becomes the COLA percentage. So however much prices go up in the Bay Area, that becomes the COLA percentage. And the COLA is posted on April 1st for everyone who's in retired status as of April 1st. Okay, so if this is going to be your first year of retirement, if you retire on April 1st, that's your first year of retirement or before, When that April 1st comes around, you will get the cost of living increase for that year. If you retire on April 2nd, or after that, you will miss the cost of living increase for that year. But when next year's April 1st comes around, you'll get that cost of living increase and the cost of living increase for every April 1st that comes around for the rest of your life. So the reason that I'm telling you this when in talking about choosing your retirement date is a lot of people who are retiring in the spring are cognizant of this cutoff, and they want to retire on or before that April 1st date if they're already thinking about retiring in the spring. And so that's why March is our biggest retirement month and April is our smallest retirement month, because a lot of people don't retire in April because they already retired to get the cost of living adjustment for that year. Now, I said that the percentage inflation for the Bay Area becomes the cost of living adjustment, kind of. What really happens is we take the percentage, and if it's more than the maximum for the limit that we can give you under the law, then you get the maximum. So for example, if the inflation is 5%, you have a maximum for tiers 1 and 3 of 3% annual cost of living increase, and for tiers 2 and 4, a 2% annual cost of living increase. Okay, so that would be the maximum you could get in any one year. But then if inflation is higher than those numbers, we will actually save those percentage points for you for future years in your COLA bank. If next year comes around and inflation is only 1%, we will actually take percentage points out of your COLA bank to add to that 1% to get you up to the maximum if we can. The bottom line here is that if you've been retired for at least a few years, people tend to have percentages in their COLA bank, and you tend to get the maximum every year if you've already been retired for at least a few years. Okay. So to answer your question, that is up on the board. So going back to this cost of living increase discussion, the question is, if your separation date is on March 31st, which is you're saying is a Friday, can you get the cost of living increase for that year? And the answer is yes, because your separation date would be March 31st. Your first day of retirement has to be at least the next day, which would be April 1st. And because you are in retired status on April 1st, then you would get the cost of living increase for that year. So that is the cutoff. Now, if your separation date is April 1st and your first day of retirement is April 2nd, then you miss the cost of living adjustment for that year. Okay. This topic comes up sometimes, so I made a whole slide about it. People ask, what happens if there's a conflict between the age factor percentage dates and the COLA date? So let me just go ahead and explain that to you briefly. Let's again stick with the example of a January 15th birthday. Okay, so this is a general member, they're age 54, and I'm just saying that to illustrate that they haven't yet reached the maximum age factor for their tier. So 1 quarter after their birthday is April 15th, so they could achieve an age factor percentage increase if they retired after that date. Okay, they're already retiring in the spring, and they're thinking, should I retire April 16th or April 1st? If I retire April 16th, I would get the age factor increase because that's 3 months after my birthday, but I would miss out on the COLA that I would have gotten had I retired a couple of weeks ago on April 1st. Or should I retire on April 1st, which means I'll miss the age factor increase that I will get in a couple of weeks if I had waited till April 16th to retire, but I will get the cost of living increase for having retired on April 1st. Which do I do? Well, you probably already know what the answer is because I gave you the percentages, but if the cost of living adjustment is the maximum for that year, then you're going to go with the cost of living adjustment, because you would get a 2% or 3% increase that year, starting at the time of retirement for the rest of your life. You would get that immediate 2 or 3% increase versus the 1% and change increase you would get with the age factor percentage. Now, if then you decide, you look at your benefit estimate and you decide, actually, I don't want to retire until the summertime. I want to earn a little bit more toward retirement. and I'll retire after July 16th, which is the next quarter year date. Well, that would actually beat the cost of living adjustment, because you would go up one notch for April 16th, you would go up another notch for July 16th in the age factor column, and then in the service credit column, you would have another 3 months of work of service credit that you earned, and that would beat the cost of living adjustment. So in general, in all cases, there is a time after the cost of living adjustment date each year where it would have been more advantageous for you to retire on April 1st or before versus retiring like in April or perhaps even May. But then it will resolve itself, because you'll earn more credit toward retirement by earning more service credit, perhaps by passing more of those age factor percentage dates, and then you will have earned more than you would have had you retired on April 1st. So that's how that works. I do have the question on the board, what is the COLA rate for this year, Tier 2? Okay, so the way it works is, in early February, we know what the cost of living adjustment is going to be for that April 1st. So, I don't remember what it was for this past April 1st, but if you go to acera.org/COLA, I can tell you. So it was the max, because the inflation was 4% from December to December, and so it was the max it was 2% for tiers 2 and 4 and 3% for tiers 1 and 3 for this past year. Now those percentages are going to be totally different next year when April 1st comes around, because it'll be based on whatever inflation was in 2022. But yeah, in early February, we know what the cost of living adjustment is, and we post it out on the website. Okay, so this is the second to last item that you may want to think about when choosing your retirement date. Okay, this is number 5. If your intention is to go straight from active work into retirement, in order for Acera to automatically do the sick leave conversion for you, where we're taking your unused sick leave and converting it to service credit for the retirement formula. If that's your intention, then you're going to want to go straight into retirement by having your retirement date that you choose, that you write on your retirement application, be the day after your last day on payroll. Okay? The last day on payroll is also another way to say it is your last day of work. Another way to say it is your last day of active employment status. This is the date that you're writing on your letter of resignation. In this example, it's the 24th of the month. And in this example, your retirement date would be the next day, the 25th of the month. And that's how you go straight from active work into retirement. And if you look on that page that I showed you, the Preparing to Retire page, there's actually somewhere in there is a template for what did I just say? A resignation letter for your employer, if you want to use that as your resignation letter. Okay, the last topic is very much related to the previous one, so it's really about granularly choosing that retirement date. You're going to want to retire on a day after you are scheduled to work. Okay. If your intention is going straight from active work into retirement. Now, if you are one of those people who's going to defer your retirement to a later date, you're just going to stop working and then retire later, you don't have to worry about these last 2 points. This is simply trying to pinpoint to help you choose a date where you're going straight from active work into retirement. So you will want to retire on a non-holiday day where you're scheduled to work the day before, and I think I've even been told that your last day on payroll should not be a holiday as well. Okay, but the main point is that your day of retirement should be a day after you're actually on schedule to work. Okay, it's okay if you're on leave that day, on vacation leave, on floating holiday, on sick leave, whatever. That's totally fine. But it should be a day after you're scheduled. So for example, if you work Monday through Friday, you're not going to want to have your first day of retirement to be on Sunday or Monday, because you don't normally work Saturday or Sunday. Okay. If you are one of those Acera members who does not have a regularly a regular schedule, regular work schedule. Maybe you work in healthcare, or maybe you work in law enforcement. You may not have a regular schedule. So what you may want to do is pick like a retirement week and kind of shoot for that week. And then when it gets more closer to the time and you see what the schedule is going to be, then you could adjust your retirement date so that it is going to be a day, your first day of retirement will be a day after you are scheduled to work. Okay, so the bottom line is your last day on payroll, you want to be a day that you are scheduled to work. Okay, so I gave you all the information I know about picking your retirement date. So maybe that changed a little bit what your projected retirement date might be, or maybe it didn't, but you can go ahead and fill that in on your worksheet if you like. And if your intention is to go straight from active work into retirement, all you simply need to do is take your retirement date, subtract 1 day, and that is your separation date. So you could write that in as well. Okay, so let's talk about the actual process that you use to apply to retire. What is that process going to look like? Okay, let me take you through it step by step. Step 1 has kind of sub-steps to it, which is step 1 is go through the Preparing to Retire section on the website. So I already showed that to you. Let me show it to you again. You go to, from the home page, you can scroll down and go to the Ready to Retire, and there's Prepare to Retire. You can also find it under the members heading, Preparing to Retire. They both go to the same place. This is our section where we have, in chronological order, given you the basic things that we think that you should do before you retire. It's like information that you should know, and there may be some activities in there for you. You have probably already done some of these things, so you're well ahead of the curve, like verifying your retirement eligibility. We already talked about that, so check. Understanding how vacation pay affects your pension. We already talked about that. Check. Estimating your retirement income, if you've already done that. Check. Attending pre-retirement seminar, you're doing it right now. Check. So you've probably already done a lot of this stuff. But there's things like addressing any community property settlements, having documents on file, providing proof of name change. And then the last two are scheduling a counseling session and applying to retire. So let me go back to the checklist in the presentation to go through that more. Okay, so that's step 1, go through that section. Step 2 is to set up that Ready to Retire counseling session, and you do that on the link that I just showed you, which was the second to last button there. On that, I'll just go back to it to illustrate the point. It's the second to last thing. You just click here, and it's a form that you fill out, and we want you to do it 3 to 6 months before your retirement date for optimizing our ability to calculate your retirement and get you right into retirement. But if that doesn't work for you, then just do it if you want to, just sometime before you retire. And this is something that we highly recommend, doing the counseling session, but it is optional. But you simply just fill out this form, tell us when your projected retirement date is going to be, tell us whether you want a phone call or a Zoom video call. We are doing some very limited in-person office appointments, but why not do Zoom? It's super easy, and you don't have to get out of your pajamas. Okay, so if you're working at home, if you're working in the office, maybe you want to come down to our office. And then, so you just hit submit, and then that's how you schedule the counseling session. We will contact you after that to actually get it scheduled for you once we process all that information. And we will schedule the session for the 3-month period before your actual retirement date. Okay, so we're saying within 3 to 6 months, schedule the session, and then it will get scheduled for the 3-month period before your retirement date, that 90 days. Okay, also within that 90 days is when you're going to want to submit your retirement application. So the very last item on that page actually takes you through submitting your retirement application, applying to retire. So this is even more step-by-step process in applying to retire. You're going to decide on your retirement option, and then you are going to come down here and complete the retirement packet. There is a retirement application, and then there are some healthcare forms to fill out. And we have made all these forms in DocuSign now, so you can do it all online. You don't have to print out paper, like get a printer, get a scanner, or take photographs of it with your phone. You don't have to do any of that anymore. It's all through DocuSign, and it's super easy. You could do it on your phone even if you want to, because DocuSign works on your mobile phone, smartphone. Okay, so you fill out the application and you submit that within the 90 days. And I think that they're having you submit it before your counseling session, and then during your counseling session they'll go over your application with you to make sure everything is correct. It looks like I need to go ahead and update this slide, because this is saying that the old way of doing it was this option election agreement, but we relaunched our application in January, and you're actually selecting your retirement option in the retirement application. So you're going to do that in the retirement application. Select one of 5 retirement options. So you submit your retirement application, you go to your retirement counseling session, and then once whatever day you said was your retirement date on your application passes, you're retired. Amazing. You're collecting that retirement that you've worked very hard to earn throughout your career. So congratulations, you are almost retired. It's going to be amazing. Okay, so that's the retirement application process. So going back to your worksheet, now that you know the date to submit the Ready to Retire counseling form is, you simply take your projected retirement date, subtract 6 months, and put that date in here. And that's how that works. For your first retirement check, you can expect to see that within 4 to 6 weeks after your last employer's paycheck. Okay, it all depends on what day in the month that you retire. Now, for almost everyone these days, I think it's like 99% of members, we get you right onto, as soon as you start receiving retirement payments from Acera, you're getting your final calculated 100% Acera retirement payment. But occasionally these days we do have people who have missing documentation, or there's divorce orders pending, or there's other issues. If that happens, we will still get you on your retirement payments within the 4 to 6 weeks after your last employer paycheck. It's just you'll get an estimated 80% payments until we resolve the issue, and then you'll receive retro payments for any less than 100% payments. But for, like I said, 99% of people, that doesn't happen anymore, because we totally revamped our retirement process, and that's why we want you to actually schedule that counseling appointment 3 to 6 months in advance of your retirement date, and that helps us start that process for you, where we can get you right on the 100% payments. Okay, there's a question. So it is paid after the month it is earned. Yes. So you will receive your retirement check for the month on the last for each month on the last business day of that month. So that's how that works. Sure. Okay, here are your 5 retirement allowance options. These are the 5 options you will be choosing from on your retirement application. So what you're choosing is a combination of what your retirement allowance is going to be and what your beneficiaries are going to receive after your death. Okay, there's 5 options: the unmodified option and options 1 through 4. For each one of the options, I'm going to show you a slide that has a ton of text on it. I apologize for that. But what it will show you is the name of the option, what it pays you, the retiree, in the top row. It'll talk about your retirement allowance as a retiree. And then the rest of the rows will talk about what your beneficiaries will receive upon your death. Basically, your death benefits to your beneficiaries. Okay, so I'll show you one slide for each one of the options. So let me talk about the first one first, unmodified option. This pays the maximum retirement allowance of any of the 5 options to you, the retiree. So this is the one that the majority of people select, just because of that. Now, this one is subtitled 60% to beneficiary because that's what it does. It pays a 60% monthly continuance to a qualified beneficiary. Okay, now let me define that. Beneficiary, that term just is somebody who gets benefits. So your ACERA beneficiary is somebody who gets your death benefits upon your death. It's the person that you name to get your death benefits upon your death. So when I said that a qualified beneficiary can get 60% monthly continuance, it's a limited group of people, and that could either be a spouse or, say, registered domestic partner, and they're qualified because you have married them or registered them with the state at least 1 year before your retirement. Okay, then you can name them for the 60% monthly continuance. And it's the continuance, let me define that. Continuance is just a continuing monthly payment after your death. So you're getting your monthly retirement allowance, and then you die. There is a continuing monthly payment for some period that we call a continuance. Okay, if it's a spouse or state registered domestic partner, it's a continuance for the rest of their life. Now, if you don't have a spouse or state registered domestic partner, but you have a minor child or children, you can name them as your continuance beneficiary. They're not going to get the monthly payment for the rest of their life. It's temporary, and it stops at age 18. Unless they maintain enrollment as a full-time student in an accredited school, and then it can continue until age 22, at which point it will stop. Unless they get married or they register a domestic partner with the state, and then it stops. Okay, so if you don't have a spouse, state registered domestic partner, or minor children, but you want the maximum retirement allowance, you can still take the unmodified option. Lots of people do that. That's perfect. You can, the unmodified option is great, okay? And you can even still name a beneficiary. It's just that you cannot name a beneficiary for a monthly continuance, because that's only under this option for spouse, state registered domestic partner, or minor child. But you can name a beneficiary for a one-time lump sum payment. Now that one-time lump sum payment will consist of basically the balance of your contribution account. Okay, so you can name anyone, and the balance of your contribution account means that all of your employee contributions that you paid into ACERA throughout your entire career is in your account, plus all the interest that we have paid to your account based on us investing your contributions. That also will get paid out, minus any retirement allowance payments that we've already paid to you as a retiree. Okay, so whatever money is left over in there, we give that back to your beneficiary. Now, one thing I'll tell you about that is if there is there may be no balance left in there if you live past 3 to 5 years after your retirement date. Okay. Another way to say it is that your balance of your contribution account is exhausted within the first 3 to 5 years of your retirement because we're paying out that money to you in monthly retirement payments first. And so the balance of that account can be exhausted. So that if you're choosing a lump sum beneficiary in the unmodified option, that's the bad news. The good news is that what that means is that everything you paid into the retirement system, and this goes for everyone who chooses the unmodified option, everything you paid in the retirement system within the first 3 to 5, everything you paid into the retirement system over your entire career, plus interest, we give all of that money back to you within the first 3 to 5 years of your retirement. And then beyond that, you get a monthly payment for the rest of your life. It's amazing. Everything after that first 3 to 5 years, it's like this amazing bonus. But it's a benefit that you've earned because you participated in a defined benefit pension plan, which the entire goal of that is to provide you a secure retirement for the rest of your life that you can count on, which is a benefit to you. So that's my little spiel about the balance of your contribution account in the first 3 to 5 years. Okay, now going back to the unmodified option. there is a scenario where at the time of retirement, you had a continuance beneficiary that you named for that 60% monthly continuance, but then you retire and that person passes away before you do. Now, if that should happen, you do have the opportunity in retirement to name a new beneficiary, but not for continuances, only for lump sum payments. The only opportunity to name a continuance under any of the options is at the time of retirement on your retirement application. Okay, so the same thing goes for if you're unmarried at the time of your retirement and you name a lump sum beneficiary and then you get married in retirement, you still cannot name your new spouse for a continuance. The only time you can do that is at the time of retirement, right before retirement. Okay, so is that all I want to say about the unmodified option? There is a question, what if there is a disabled child, and I take that to mean what if there's an adult disabled child, would they count for the monthly continuance? They would not, because they're not a minor, but there may be another option that would work for that, which I'll get to in just a minute. And then there's a question, how does the child beneficiary apply to more than one child? Depends on the percentage of distribution of 4 kids, for example. Unmarried status. Okay, so if you have more than one minor child, what they would get is we would divide up the continuance among them. So they would get a percentage of that 60%. So in your example, if you had 4 kids, they would each get 15%, a 15% continuance. Because we take that 60% and divide it 4 ways. And then each one individually, I believe, has the different cutoffs where the continuance stops based on their age and situation. Yes, so for the unmodified option, they have to be minor children. Yes, that's correct. Okay, now you may want to look at options 2, 3, and 4, which I'll get to in just a minute. If you have an adult child who is disabled. Sure. Okay, option number 1. So we moved past the unmodified option. Now we're on option number 1. This one is the only one of the 5 options that never leaves a continuance to anybody at any time. Okay, what option number 1 does is, for you, the retiree, it gives you, in your retirement allowance, almost the same amount as the unmodified option. It's slightly less. What it does is, if you are somebody who does not have a continuance beneficiary that you want to leave a continuance to, it makes it so that the time where there is a lump sum amount left for a lump sum beneficiary expands from 3 to 5 years after your retirement to 10 to 12 years through some different type of accounting. So again, it pays a little bit less than the unmodified option to you, but you name a lump sum beneficiary, and if you died within that first 10 to 12 years, then there would be a balance left in your contribution account to pay out to that beneficiary. And one more thing that I'll say about these lump sum death benefit payments is, even if your contribution account is exhausted, you still will want to have lump sum beneficiaries named, because there are some smaller amounts that will get paid out to them, like the $1,000 lump sum payment that I said was a vested payment earlier in the presentation. Also, a partial month of your retirement allowance that we're not able to pay out to you by the time of your death. Also, if you enroll in one of our healthcare plans, you pay those the premiums a month in advance, and so that would be refunded. So there are little payments that could be paid out, and you can find more about those on our death benefits page if you go to acera.org/death. Okay, so that's option number 1. Now option number 2 is subtitled 100% to beneficiaries. So you can kind of see what this is probably going to do. It's going to pay to your beneficiary, rather than a 60% monthly continuance for their life, it's going to pay 100% monthly continuance. Okay. It also makes it so that you can name anyone as a beneficiary. It also makes it so that if you choose a minor child, it doesn't cut off at a certain age. It will go for the rest of their life. Okay. It also makes it so that because you can name anyone as a beneficiary, you could name an adult child who has a disability. So this is where you could do that, and you would be leaving them 100% monthly continuance. So that means that whatever your retirement allowance is every month, at the time of your death, they would get paid that same amount every month for the rest of their life, plus cost of living increases that they would get. Now the caveat is that it's going to pay less than what the unmodified option would pay you had you chosen the unmodified option. And the reduction is based on your the life expectancy of your beneficiary. So if your beneficiary is a lot younger than you, they have a longer life expectancy, Sarah is going to expect to pay them more, so we're going to pay you less in your retirement allowance. And those calculations are all done right at the beginning when we calculate your retirement allowance. So whatever we calculate your retirement allowance to be, that's what it's going to be for the rest of your life. And we'll calculate that reduction right at the beginning. And then if your beneficiary dies before you do, should that happen, we don't recalculate your retirement allowance. So whatever, like I said, whatever your retirement allowance is at the time of your retirement, that's what it's going to be for the rest of your life, plus cost of living increases. If your beneficiary is not your spouse and they are at least more than 10 years younger than you, there is an additional rule that the IRS has, which means that you may not be able to leave them 100% monthly continuance. If you look on our page that explains all of these options, which is acera.org/retire, which is that retirement application page, which is the last step on the preparing to retire page. In fact, I'll just show it to you again. So I got here by going under members, preparing to retire. It is the last step, applying to retire. This is what takes you through the application process, and this also explains those options in detail. It's a lot of the same stuff that I'm explaining to you, and it tells you more details about that 10 years younger rule, and it helps you figure out whether, if it will pay 100% or less, if that's the scenario for you. So if your beneficiary is more than 10 years younger and it's not your spouse or state registered domestic partner, there's that additional limitation. Okay, so I think that's the last thing I wanted to say about option 2. Again, it does two things. It allows you to name anyone as a beneficiary for a lifetime continuance, and it pays 100%. Option number 3 is the exact same as option number 2, except for how much it pays to the beneficiary. Rather than paying 100%, it pays 50%. So whatever your retirement allowance is at the time that you retire, your beneficiary is going to get half of that amount for the rest of their life, plus cost of living adjustments. But all the rules are the same. Your beneficiary can be anyone. It does pay less than the unmodified option, but because in option number 3, we're paying less to your beneficiary than option number 2, this is going to pay to you more than option number 2 in your retirement allowance, because in option 2 we're paying more to the beneficiary 100%, in option 3 we're paying less to the beneficiary 50%, so we're going to pay more to you in your retirement allowance. But all the same rules apply as option number 2. The final option that you can choose is option number 4, where you can specify an amount that you want to go to in a continuance to one beneficiary or more than one beneficiary. Okay, so option number 4 gives you a lot of different options, like different iterations of what you can do. Again, this is going to pay less than the unmodified option. Okay, so what you can do is you could specify one beneficiary to receive a certain dollar amount or a certain percentage, or more than one beneficiary, and that is for the continuances. So for example, you don't have any children, but you have a nephew, and you don't want to leave that nephew 100% under option 2, that's too much. You don't want to leave him 50% under option 3, that's still too much. You could leave him 10% or 15% or 20%, whatever percent you want, as a continuance to that beneficiary. Or let's say that you have two beneficiaries. Let's say you have a son and a daughter. You could leave them combined a 100% continuance. So you could leave them a 50% continuance to your son, 50% to your daughter. Let's say they're both adults. So you could do that, and it would be a lifetime continuance after they pass away. Or you could do it less than that. You could leave your son 20 and your daughter 20, which would be a combined 40% continuance between the two of them. Or you could specify a dollar amount if you wanted to go to them. So you have a lot of options under this. The amount less that it's going to pay you than the unmodified option is going to be based on the youngest beneficiary's life expectancy, and basically also how much of a continuance you're leaving to them. The calculations for this, because there's so many different permutations of what it can do, our benefit estimator online does not give you an estimate for option 4. So if you want an estimate for that, you have to ask for that in your counseling session when you talk to your counselor. But all the other same rules apply as options 2 and 3, because they're all kind of similar. Options 2, 3, and 4. It's just for option 4, you can name more than one beneficiary and you can choose the percentage that you want to leave. Option 4 is another one where if you're trying to leave a really high continuance, like 100%, that same rule may apply, where if you're trying to leave it to someone who's not your spouse or state registered domestic partner and they're more than 10 years younger than you, you may not be able to get up to 100% to what you can leave them. And again, that page that I showed you will tell you how to figure that out. Okay, there's a question. So you need to choose option 1 if you want any employee balances at the time of your death to go to your beneficiaries. The reason that you choose option 1 is that you don't have anyone you want to leave a continuance to, but you're still interested in having basically the highest retirement allowance that you can get. I mean, really the highest retirement allowance you can get is the unmodified option, but option 1 pays slightly less than it. It may be like a few dollars. And the reason to choose it is you don't have a continuance beneficiary you want to leave a continuance to, which would be a continuing payment every month. But you want to kind of set up the scenario where there would be a balance left in your contribution account should you die within the first 10 to 12 years after retirement. So that would be a reason to choose option 1. Okay, so I showed you what all the options do in general. If you want to get a specific estimate for each option, you just go back to the benefit estimator. So again, here's that screenshot that I showed you before. And now some of this will make a little more sense. Okay, so when you're filling out the estimator form, you're going to want to make sure that you choose your beneficiary information correctly. Okay, if you've already designated your beneficiaries for active member death benefits, which means that should you die before you retire from a SARA, there's a different set of benefits that would go to your active beneficiaries. If you have done that, and hopefully you have, if you have not, you should go into your account and look to see who your beneficiaries are and make sure that they're up to date. And if not, there's instructions in there for how to redesignate them. But you will see your current beneficiaries in this drop down, and if you select one of them, just make sure the date of birth is correct, because some of them are not, and that will throw off the calculations. Okay, then you hit Get Estimate. Okay, now here's your retirement estimate, and I'll zoom in. Now you can see that these options make a little more sense. So you have the unmodified option. You'll see that this has the highest dollar amount of any of the other options. Okay, it also gives you an estimate for how much your beneficiary will receive after your death. And you'll notice that the beneficiary allowance option for the unmodified option is 60% of the member allowance option, because it pays a 60% continuance to a spouse, domestic partner, or a minor child. You'll notice that option number 1 is a little bit less than the unmodified option. You'll notice that option number 2, between the member allowance and the beneficiary allowance, it's the exact same amount, because it pays 100% to the beneficiary of whatever you were getting paid. And you'll also notice you can also see what the reduction is from the unmodified option based on the life expectancy of your beneficiary.
You'll notice option number 3 pays more than option number 2 because it pays the beneficiary less, and then the beneficiary allowance is 50% of your member allowance under option 3. And then option number 4, again, you have to talk to your counselor in your counseling appointment to get an estimate for option 4. So that should make the retirement estimate page make a little more sense for you. There are 2 other numbers here for option number 1. This kind of helps you get an idea of how long that money will last, the balance of your contribution account will last, because it shows you the total balance, and then it shows you how much money will come out of that total balance every month that we pay you a retirement allowance amount. And so you can, what I was telling people before is that you can divide the big number by the little number and it will tell you how many months it will last, and you could divide by 12 and it'll tell you how many years it will last. But I learned recently that it's a little more complicated than that. There are some other amounts that might come out of there, and so you can't do exactly that, but if you do that, you'll find that the money will last about 10 to 12 years before it's exhausted from your contribution account. Okay, good. So we have 25 minutes left, which is almost exactly enough time for me to talk about other benefits, including healthcare benefits. So let's jump right into that discussion. I told you earlier in the presentation about vested benefits, and I told you that meant guaranteed benefits. So we also have this set of non-vested benefits, also known as non-guaranteed benefits, that are considered extra benefits on top of your guaranteed benefits. Now, because these are non-guaranteed, that means that they might change or that they might be reduced or eliminated in the future. The way it works is that at some point in the past, the county decided that the retirees needed this extra set of benefits to pay for their lives in retirement, and so they started this reserve fund that is funded kind of in a novel way, which it gets regular interest when Acera's investments earn interest, and then half of any unexpected interest that we make above what we expect, that also goes into this fund. So this fund tends to accumulate a good amount of money. It's called the Supplemental Retiree Benefits Reserve, and it is administered by Acera's Board of Retirement. There is currently $1.1 billion in this reserve fund to pay for these benefits. So there's a lot of money in there, okay? And it's currently considered really sustainable based on our actuarial projections. But the Board of Retirement, the reason I'm telling you this is just to kind of highlight the idea that these are non-guaranteed benefits. The Board of Retirement determines what the benefits are that this money in this reserve fund goes to pay, and they kind of monitor the sustainability of this fund year to year. And they do. They monitor the sustainability of it for year to year. And they might reduce or eliminate some of the benefits or change the benefits in the future. So they don't do anything, they tend not to do anything hastily. They'll make little adjustments over time just to ensure the sustainability of the fund, but it is something that could happen. And so if you want to keep up to date on that, a good way to do it is to subscribe to our Acera news. If you go to acera.org/subscribe, we will send out news, about stuff like this, like important stuff. Maybe once a year, maybe once every other year, there's some piece of news that we need to send out. So that's how you would keep up to date on that. But for the short term, what I want to tell you about these benefits, what they currently are is this set of 5 benefits. There's a medical subsidy known as the monthly medical allowance, which is what MMA stands for. There's a dental subsidy, a vision subsidy, a Medicare subsidy, and a supplemental cost of living adjustment. So for the medical, dental, and vision, if you enroll in our medical, dental, and vision plans and you're eligible for the benefits, then you get the subsidy to help pay for the plans. For Medicare, if you enroll in Medicare and you start paying the federal government money for being enrolled in Medicare, if you're eligible for that subsidy, you will get money from Acera, from this reserve fund, to help pay for that. The qualifications are based on the amount of Acera service credit you have when you retire. So for one of the benefits, the supplemental cost of living adjustment, which is an extra cost of living adjustment that is paid on top of the guaranteed cost of living adjustment, and this maintains your buying power in retirement. You don't need any ACERA service credit years to qualify. Everyone has access to that once they lose enough buying power in retirement. But for all the other ones, you can see that you need at least 10 years of ACERA service credit to qualify. Or if you have a service-connected disability retirement, you would qualify for them as well. Then with the medical subsidy, there's actually 3 levels of it. So if you achieve 10 years of ACERA service credit, there's one level, you get half of the monthly medical allowance. 15 years, you get 3/4 of it, and if you achieve 20 years of ACERA service credit, then you would get have access to the full monthly medical allowance subsidy. And again, this is ACERA service credit. This is no reciprocal service credit counts for this if you have reciprocity. Let me tell you about each one of these benefits in some detail. That will help you understand what they are and how much, if you're eligible for the subsidies, how much you can expect them to pay for the benefits. So I'll talk about the monthly medical allowance first. The monthly medical allowance is, again, not a guaranteed benefit. None of these are guaranteed benefits. Okay. What the monthly medical allowance does is it offsets the cost of a ACERA-sponsored retiree medical plan. So if you enroll in one of the medical plan options we offer you as a retiree, then if you're eligible with 10 years of service credit, at least, for the monthly medical allowance, then this will offset the cost of you being enrolled in one of our plans. Because there is a monthly cost called a premium for our group plans, or there are individual plan options where you pay a premium and then there may be copays and deductibles. And the monthly medical allowance for the individual plans can offset the cost of also the copays and deductibles. The amount is set annually by the Board of Retirement. Any part of the costs that exceed what the subsidy is, the monthly medical allowance, you will be responsible for paying. The monthly medical allowance is only available to pay your medical expenses, not for your beneficiaries, survivors, spouses, former spouses, dependents. You can enroll them in coverage, but the monthly medical allowance subsidy does not pay for part of their coverage. Okay, so there's a question that just popped up. Is the monthly medical allowance shown for self or for self and spouse? It's just for you. It's just for the self. Okay. Will the monthly medical allowance be available to me if I move outside of California? Yes. And I'll get to that in just a minute. So here are the dollar amounts for 2022. Okay, the full monthly medical allowance amount is $596.79. The 3/4 amount and that's for 20 or more years of ACERA service credit. At least 15 years of ACERA service credit would get you $447.55. The at least 10 years of ACERA service credit would get you $298.37. Okay, so think about those dollar amounts. That's the subsidy amount. Now I'm going to show you the plans, the medical plans that we currently offer and what the costs are for those. So first of all, our open enrollment for our medical plans is every November. So that's it's just like your active member open enrollment. That's your kind of free period to change plans whatever you want. Now outside of open enrollment, you can change plans or enroll in medical coverage with a qualifying event, such as retirement is a qualifying event because you're losing your ability to be on your active healthcare coverage, and so that's a qualifying event, and we'll get you right into our ACERA healthcare coverage without a gap in coverage. So our healthcare unit will help you right into that. Now, what I'm going to show you for the plans is 2 sets of plans. Okay, two categories here. I'm categorizing them under non-Medicare eligible plans and Medicare eligible plans. So Medicare is where the federal government has the system for providing healthcare coverage. And so if you're generally eligible for it once you reach age 65 and you're over age 65. And so then what you do is you sign up for Medicare, the federal government provides your coverage, and if you want to, you can enroll in an extra plan that provides a higher level of coverage which is what I'm going to talk about here, those extra plans. If you're not yet Medicare eligible, then the plan will just provide your full amount of coverage. Okay, and you can see that there's 3 companies here, Kaiser Permanente, United Healthcare, and Via Benefits. What I'm going to tell you about is the group plans through Kaiser Permanente and United Healthcare first, and then I'll talk about individual plans through Via Benefits together, combined between non-Medicare eligible and Medicare eligible, because it's more efficient that way to talk about that. I'm only going to show you the costs, and there might be a couple of other details. If you want the full details, you can always go to our enrollment guide that we publish every single year that has the full details of all the plans. If you go to acera.org/guide, you'll see the PDF of that, and you'll also receive that in the mail every year in October. Excuse me. Okay, so first I'll show you the plans, your plan options if you are not yet Medicare eligible and you live in our group plan service areas, which are all in California. It is the Bay Area, Sacramento, Fresno, Southern California, and for Kaiser, it is also Santa Cruz. Okay, so if you live in those service areas, you can enroll in one of these group plans. If you live outside those service areas in California or in another state, then you're going to be looking at an individual plan through Via Benefits, which I'll talk about in a minute. Okay. So these are the options. You can see the self-premium for Kaiser is $843.16. Then there's 2 United Healthcare plan options, the HMO and the Signature Value Advantage HMO. The Signature Value Advantage HMO is the cheapest plan that we offer at $781.42. And so you can see that even if you chose the cheapest plan at $781.42 and you had the 20-year monthly medical allowance at $596.73, still the monthly medical allowance still does not cover the full cost of being enrolled in the plan. You would owe, you would end up paying about another $200, a little less than $200 for your healthcare coverage. The difference between the 2 United Healthcare HMOs, you may recognize these are the same 3 plans from the county. The county actually does the contracts for these plans. It's the same 3 plans. The Signature Value Advantage HMO, the reason it's cheaper is because they have this high-performing network that you have to stick to that I guess is like a higher efficiency, and so it makes the plan cheaper. But when the county studied it, they found that everyone who was in the Signature Value HMO, the providers that they were going to, like 99% of them, were already going to all the providers in the Signature Value Advantage HMO, so there was no reason to stay in the Signature Value HMO for more money. Okay, now I mentioned that you have the premiums, right? You have the monthly premiums, and then if you're eligible for the monthly medical allowance, that's a subsidy that helps you pay for the cost of these. Well, how does that money move around? Okay, here's how it works. Here's a very crude illustration of your Acera check stub that you're going to get for your retirement allowance when you're a retiree. So you'll get a direct deposit, and then you'll get an electronic check stub. You can opt in for paper if you want, but I recommend the electronic. It's nice and easy, and you can see all those electronic check stubs in your account. Okay, so here's your retirement allowance, your gross retirement allowance, $4,000 in this example. You will see a deductions column. If you enroll in one of our medical plans, you'll see the premium come out of your check if you enroll in one of our group medical plans. So this person has enrolled in the Kaiser Permanente HMO. We are taking out $843.16 from their check, and we're sending that over to Kaiser for them as a courtesy to you. Okay? So we'll pay your premiums for you. And then also automatically, if you're eligible for the monthly medical allowance, we will put that subsidy back into your check in the additions column. So in this example, this person has a 20-year monthly medical allowance of $596.73. And so what they end up, their net pay ends up being, in this crude example, $3,700 and $3,750 basically. So you're paying the difference between what the cost of the plan is and what your monthly medical allowance pays. There will be other deductions from your check that you'll see, including taxes, tax withholding, because you're going to owe taxes on your retirement income because you didn't pay taxes on the contributions going in, so you have to pay taxes on the income going out. Okay. So, those are the non-Medicare group plan costs. Now let me show you, we have one group Medicare plan that we contract for. So if you're Medicare eligible and you want a group plan through Acera, it's the Kaiser Permanente Senior Advantage Plan. And again, the service areas are the same, or similar. It's the Bay Area, Sacramento, Fresno, Southern California, and Santa Cruz for Kaiser. And then you can see that the premiums here for the self-premium is a lot cheaper than the non-Medicare plan. It's $344.44 for 2022. And the reason for that is that the federal government, now that you're Medicare eligible, is paying for most of the cost of your care, and you're just enrolling in this Kaiser Permanente plan because it provides an extra level of coverage. So this kind of works with Medicare to give you that extra level of coverage. Now, I've also broken it out here into a table where I'm showing you different scenarios for if you're enrolling self plus one or self plus one plus family, and whether you're Medicare eligible or whether your spouse is Medicare eligible or whether you're both Medicare eligible, there's different premium amount combinations that there are. And then I've put in the 20-year monthly medical allowance here to in a row to illustrate a point. The 20-year monthly medical allowance is $596.73. So why isn't that showing up here? Well, it's because the monthly medical allowance only pays up to the amount of the self-premium for the group plans. You do not get to keep the change over the amount of the self-premium. So then your monthly medical allowance becomes the self-premium and your out-of-pocket cost is zero. So the good news for that is that if you have at least 15 years of a service credit and you're Medicare eligible, then your premium cost for these extra plans is totally paid for the Kaiser Permanente Senior Advantage Plan, because your out-of-pocket cost would be zero for just yourself. Okay, then there's a question, why isn't the 20-year monthly medical allowance $596.73 on the self plus one? And that is because I told you earlier on the slide with the monthly medical allowance, I mentioned this earlier, that the monthly medical allowance only pays for your coverage. It's only a subsidy for you, the retiree, not for your spouse or any other dependents. And so that's why if you have self plus one and you're both with Medicare, you're basically paying a double premium. $344.44 goes up to $688.88. But the monthly medical allowance stays at $344.44. And so that's, you have to pay for the premium for your spouse, basically, is the cost. Is the deal. You can enroll them, but you have to pay for them. That's how that works. Okay. Okay, and you had that question earlier. Sorry you had to retype that. Let's see, there's another question. Okay, let me get to that at the end. Okay, so I showed you the non-Medicare group plans. I showed you the Medicare group plans. Let me tell you about the individual plan options through Via Benefits. Via Benefits is it's a private health insurance exchange that contracts with 100 different carriers to provide medical plans for Acera members. So we have a contract with them to match our members with individual medical plans, and you are able to use the monthly medical allowance for those individual plans. If you go outside and get your own individual plan, you can't use the monthly medical allowance. It's only for the individual plans inside Via Benefits, but there's like 1,000 different plan options. Who can enroll in a Via Benefits individual plan? So if you're not yet Medicare eligible, you can enroll in a plan if you live inside the U.S. but outside the Acera group plan service areas. So if you live in the group plan service areas, you have to pick a group plan. If you live outside the group plan service areas, you can pick an individual plan through Via Benefits. Okay, now if you're Medicare eligible, you just need to live anywhere in the U.S. and you can pick a plan. So even if it's in the Kaiser Senior Advantage group plan service area, it doesn't matter. You can choose a Via Benefits individual plan. You just have to maintain enrollment in Medicare Parts A and B. So the way it works is you enroll in Medicare for Kaiser also, the Kaiser Permanente Senior Advantage Plan. You enroll in Medicare Parts A and B. Okay, the same thing for the VIA benefits plans. You enroll in Medicare and then you choose this extra plan to enroll in as well. Okay, the VIA benefits has I have it on here 80 plus insurance carriers. I think it's up to 100, and they have 1,000 different plans. So it's an individual plan. The service area is nationwide, but there's different plans in different areas. The enrollment is over the telephone or online, and the way it works is you'll call them up. And if you call them up, you'll talk to a benefit advisor. They are non-commissioned, and they're certified and salaried, so they're not putting you into one company or the other based on some greater commission that they're going to get. They're just narrowing the plans down that they have available to what's right for you. So you call them up, you tell them where you're living or where you're going to live, how much you want to spend, what level of coverage you want to have. You can even get as granular as what doctors you want to see, what prescription drugs you need. So you can tell them all that, and they will narrow down the plans to just a few, and then you can choose among them. The monthly premiums are all different depending on what plan you go into, so it all depends on the plan. All the benefits depend on the plan. But for the for the individual plans, the monthly medical allowance not only pays for the premiums, but also if you have deductibles or copays, it can pay for those as well. Okay, so if you're eligible for the monthly medical allowance and you choose an individual plan through VIA benefits, you can use the monthly medical allowance to pay for those individual plans, but the money moves around a little bit differently than I showed you with your check. So let me show you how that works. So again, here's another crude illustration of how something works at Acera. Okay, so here's Acera, and we have your monthly medical allowance that you're eligible for here. Okay. Now, what we're going to do is we're going to send that money over to VIA benefits, and they're going to open up for you what is called a health reimbursement account, and they'll save your money there for you. Okay, and so then you're going to enroll in an individual plan through VIA benefits. Okay, then because you're enrolling in an individual plan directly to an individual insurance carrier, you're going to owe them a monthly premium every month, so you pay them directly. Okay, then you're going to use your plan. You're going to go to the doctor, and you're probably going to pay a copay. So then you're going to be out some more money. So what you do is you submit reimbursement claims back to VIA benefits, and they'll pay you out of your health reimbursement account from the monthly medical allowance money that Acera put there for you to reimburse you for your expenses. You can have this stuff set up so a lot of it happens automatically, so you don't even have to think about it, especially recurring payments to your insurance company and recurring reimbursements from your health reimbursement account, and VIA benefits will help you set up all of that stuff. Okay, so that's how that works. Now, for people who are Medicare eligible and who are choosing a VIA benefits individual plan and who are eligible for the monthly medical allowance, for you all, what the Board of Retirement has found is that those plans are so inexpensive that they wanted to have a slightly reduced set of monthly medical allowance amounts just for you all. Okay, so this doesn't apply for if you're not Medicare eligible and you're going through VIA benefits. This is just if Medicare plans through VIA benefits. And so you can see that the monthly medical allowance amounts are a little bit less. But the Board of Retirement keeps track of what percentage of people exhaust the money, that it doesn't quite cover all of their expenses, and almost everyone, it covers all of their expenses throughout the year. Okay, so let's see here. I have some questions up here. Okay, so one question, do we contact Acera for medical insurance change after retirement? No, you're going to want to do that during the retirement process. So your counselor will help you get into your insurance plan during the retirement process, so there's no gap in coverage for you. So that's how you'll do that. Okay, there's another question. I currently have United Healthcare and will be 66 and a half when I retire. Will I have to switch to Kaiser or via benefits? The answer is yes, sort of. You'll find that in via benefits there are United Healthcare plans available for you. They're just individual plans. They're not group plans like the Kaiser plan. But so if you like United Healthcare, you can find a United Healthcare plan in via benefits. But yes, there is no group Medicare plan for United Healthcare. There used to be, and it was way expensive. And so the individual United Healthcare plans through via benefits are a lot more inexpensive to you and provide the same high level of coverage. Okay, another question. Does VIA provide you with a card you can use to charge things like co-pays? I think that's all going to depend on, oh, I see. Do they provide a card where you can spend your monthly medical allowance money for co-pays through a card? I actually don't know the answer to that. They might. I know they have a app that you use to submit reimbursements, so you don't have to get paper involved to submit reimbursements. I'm not sure if they have a card though. So yeah, sorry, I don't know the answer to that. There's a question: how much will the copay be for hospitalization and surgeries if needed? I don't know. I'm sorry, I don't know the details of the plans off the top of my head. But if you go to acera.org/guide, all those details are in our retiree enrollment guide. Okay, so we are right at time, but I have a few more details about the healthcare plan. So I'll take another probably 5 or 10 minutes to do the dental, vision, and Medicare stuff. So if you just want to hang on, and I'll keep going through that. And then after that, I'll turn it directly over to Jean Hilliard to do the deferred compensation presentation. Okay, there is one more question about healthcare. If we don't need the medical insurance at the time of retirement, but we will need it later on, what do we do? Do we contact Acera? So yes, that is a really good question because yeah, lots of people want to know that. And you don't have to take the health insurance at the time of retirement. You could take it later during open enrollment. So every November is our open enrollment, is when you can sign up for insurance. Or if there's a qualifying event where something changes with your life, you can sign up during that time, like you move or a spouse retires and you lose their healthcare coverage. Those are all qualifying events. And if you want to know more about that, you go to our website, you go under retirees, you go to health plans and benefits, and click on health plan, getting and managing coverage. And then there is a lot of information in there about that. If you scroll down to, so let's see, who can enroll in plans, when can you enroll in or change health plans, and it shows you the list of qualifying events where you can make changes outside of open enrollment. Okay, there's a 457B question. I'll let Jean answer that when we get to that presentation. And then the question: do you have to live in California to sign up for healthcare? So regarding, just really quickly on that, you don't. You can sign up for a via benefits plan. If you're not yet Medicare eligible, well, in either case, if you live outside of California, you can sign up for a via benefits plan. And this is inside the U.S. only. We don't offer any international plans. Okay, let me talk about dental plans. We have two dental plan options: Delta Dental PPO, which is nationwide; Delta Care USA, which is California only. There are two kind of sections here: mandatory enrollment and voluntary enrollment. If you have at least 10 years of Acera service credit when you retire, you must enroll in one of our dental plans, but for you, it costs you $0 out of pocket for the premium. It's just cheaper to run the plan that way. So that's why the self premium column is the same as the subsidy column. So for example, you have 10 years of ACERA service credit. You choose the Delta Dental PPO. In your retirement check, you will see $44.15 come out of your check in the deductions column, and you'll see $44.15 go back into your check in the additions column. So it costs you $0, and that's how that works. And we'll send the premium over to Delta Dental for you. Oh, and one aside I want to mention here that I forgot to mention earlier, none of these subsidies are taxable income. So you don't have to pay income taxes on these subsidies. We have it worked out with the IRS where it's not taxable income. Okay, so then you can also enroll yourself plus one or your family, and you'll just pay the difference between the subsidy amount and whatever the higher premium is for enrolling self plus one or family. If you don't have 10 years of ACERA service credit, but you want dental coverage through ACERA, you can still voluntarily enroll. It's a different set of premiums, and there's no subsidy available for you. Okay. Same thing with vision. Now there's one standard plan where a subsidy is offered, and the subsidy it's the same deal. If you have at least 10 years of ACERA service credit, you have to enroll, but it doesn't cost you anything. The self-premium is $3.97 per month, and that is also the subsidy amount, so it costs you $0. Now if you want to, you can buy up into the premium plan, and you can pay the difference between the $14.26 premium for the monthly premium for the VSP premium plan, and the $3.97 will still be the subsidy for that plan. And then again, you can voluntarily enroll if you have less than 10 years of ACERA service credit. Okay, the next non-guaranteed benefit that I want to tell you about, which is number 4, is the Medicare Part B reimbursement plan. Okay, what this does is it offsets the cost that the federal government charges you for being enrolled in Medicare Part B. Okay, so just a super quick primer on Medicare. We have a whole Medicare transition seminar that you can watch a video of on our website if you want to, for when you're going to transition into Medicare, or you can attend live. We do it 6 times a year, every other month. And so when you're transitioning into Medicare, I recommend going to that webinar, and that is your primer on Medicare. But really quickly, Medicare Part A is hospitalization coverage. Medicare Part B is doctor's visits coverage. Medicare Part D, as in dog, is prescription drug coverage. Okay, so when you turn 65 and you go to enroll in Medicare, for Medicare Part A, if you have paid into the Medicare system for at least 10 years full time, or the equivalent, Medicare Part A is free for you. Okay. If you haven't, if you're a safety member and you're not paying into Medicare, you can still get Medicare Part A. There's just a cost for you, and I don't think it's very much. Now, for Medicare Part B, there's a cost for everyone. The federal government will start charging you for Medicare Part B when you enroll in that. That's the doctor visits portion. But ACERA offers you a subsidy for this. If you have at least 10 years of ACERA service credit or a service-connected disability, ACERA will subsidize the lowest cost that Medicare charges anyone, which is $170.10 per month for 2022. So you'll pay that to Medicare, and then if you enroll in this reimbursement plan with ACERA, you just have to enroll one time and maintain Medicare Part B enrollment. You'll see $170.10 show up in your ACERA check, which totally offsets the cost for that. So it's a good deal. Number 5 is the last non-guaranteed benefit. Is the Medicare reimbursement taxable? Is the question, and the answer is no. The monthly medical allowance is not taxable. Neither is the dental and vision subsidies, or the Medicare Part B reimbursement plan subsidy, or the supplemental cost of living adjustment. None of it is taxable income. The supplemental cost of living adjustment is additional to the vested cost of living adjustment. This keeps you at 85% of your original purchasing power in retirement, at least. What this means is that at some point in your retirement, if you're retired long enough, inflation will erode your buying power so much that you will lose enough buying power where the supplemental cost of living adjustment will kick in. So if you lose more than 15% of your original buying power that you enjoyed at the time of retirement, due to inflation, then the supplemental COLA adjustment kicks in and it keeps you at 85% of your original buying power. So it's actually a really important benefit. It's a really powerful benefit, and it means that you can't lose more than 15% of your buying power to inflation at any time in retirement. So it's a really good benefit. Okay. Just really quickly, this is like I already told you about subscribing to Acera News, so this is the very last slide that has anything substantial on it, and then I'll turn it over to Gene Hilliard for the 457B presentation. Really quickly, there's some life events that I want to make you aware of. They don't apply to everyone, so I don't go into detail about them, but you should be aware of these topics. If you defer your retirement, which means you quit before you retire and you defer your retirement to a later date and don't go straight into retirement, there's some things you want to know about that. So check out our deferred retirement page. If you want to know more about your death benefits should you die before retirement, check out our death benefits page at acera.org/death. If you divorce or dissolve your registered domestic partnership, either before retirement or after retirement, there are some things that you're going to want to know about that because they can affect your Acera retirement benefits, because your benefits that you earned while you're married or in the domestic partnership are considered community property in California, and those are on the table during the settlement process when you're dividing assets. So you're going to want to know some information about that. Okay, there's this type of retirement that exists called disability retirement. So what I've been telling you about is the regular retirement, also known as service retirement. Now, for disability retirement is when you become permanently disabled. You can't no longer perform your job duties, so you need to retire early, basically, and you can apply for disability retirement and retire early with the disability retirement. So if that is a topic that you're interested in, please visit our disability page on our website. Okay, also, if you're going to work after retirement and you're going to go work for somebody who's not one of Acera's 6 participating employers, have at it. We're going to consider you retired. You're going to get your Acera retirement check every month for the rest of your life, and you can go work wherever you want. Now, if you are going to return to work for your employer or one of Acera's other 5 participating employers, there are some restrictions on that. So you're going to want to check that out on our webpage about working after retirement. And if you relocate after retirement, always please submit an address change form to Acera so we know where to send you your open enrollment packet, your annual report that we send you, and any official correspondence. If you ever have questions, always feel free to email us. We have a contact page, acera.org/contact, where you can email us through there. You can always call us during business hours at 510-628-3000. Okay, so at this point, and I'll just say at this point, on behalf of Acera's Board of Retirement and Acera's staff, we wish you a beautiful retirement. It's amazing. You earned it. So thanks for spending this time with me, and have a beautiful rest of your day and a beautiful life. So thanks.